Good morning, students. We welcome you to the BoS for Success session of elective paper 6C International Taxation. I'm CA Priya Subramanian.
I'm C. Aparna Chauhan.
And actually, before we proceed we will be taking up some of the important developments, very crucial points, because, within that time of limited time, we have to cover the important points, which students generally tend to go wrong in the examination situation. But as regards the paper, all of you know it's an open book examination. So the problem of retaining the voluminous provisions that you won't face in this particular paper. What is the applicability? Basically, the October 2021 edition of the study material, you have to read it along with the supplementary study paper 2022. That has been web hosted at the BoS Knowledge Portal also. So you have to read that material along with the supplementary study paper 2022. Then one thing which you have to keep in mind, international taxation, what has been included in the content of 6C is very specific. It presupposes, so therefore this paper presupposes the knowledge which you have gained in paper 7 direct tax laws and international taxation. See, once you've done that particular paper, whatever is there, whatever all the provisions, it might not be separately given in your international taxation material, but that also can be tested, like deductions for gross total income. It is not covered in international taxation per se, but of course your question can involve applicability of that also. This is one of the examples, but whatever is covered in 6C, paper 7, that you have to be thorough with. And for that purpose also, the October 2021 edition of paper 7 study material, along with the supplementary study paper for paper 7 and judicial update for paper 7. So all this, you must be very conservative. All the amendments which are relevant for the paper 6C examination. Both paper 7 amendments plus paper 6C amendments. Now, what the papers and open book examination. So, what can you take as open book? That is what that is another important things which students have in it. You have to take your study material for international taxation and for direct taxes. Income Tax Act and rules are must. You have to take the Income Tax Act and rules. Then supplementary study paper 2022 for direct taxes and international taxation. All this you will have to keep it with you as part of your open book. Then actually, one thing is this particular paper, students tend to find it a little bit tough. The thing is, open book doesn't mean that you have to open it the day before the examination. That is something very important, because open book, generally the standard of examination is always higher universally, that in any course for that matter. If it's an open book exam for a particular paper, the level will be higher, because there you are expected to see, they're not going to ask you some straightforward question which you can take it from the material and give it there. So everything, your application, you have to be thorough with the concepts. You have to be thorough with all the provisions beforehand. And you have to know where to find information. It's an open book. In the exam, now you can't keep flipping over the pages. If I've forgotten the rate, presumptive rate of taxation under 44 BB or something, then I have to know, I'll find it in non-resident chapter in this particular, this thing. It comes after this particular, after discussing the provisions of residential status, exempt income, then it comes. So you'll be able to you should be able to find it out. So you must know and how to apply it. For that, you should have practiced extensively, because this paper is a very application oriented paper to test all the concepts which you have learned and in each chapter, each topic. So when it's application oriented, it tends to be a little bit more difficult. You have to be very careful. You have to know to determine the residential status properly. If there is a particular question, information is given, galore information is given relating to computation of total income. To what extent it is relevant, that you have to see. For that, residential status you have to determine. If you have information relating to residential status, generally it's given in an international taxation paper. Either it's directly given or they have given you information to determine what the residential status is. So it's very important. A few exams, in one of the exams, what happened, they had given all the information relating to a person. Okay, that person stays in India. He's returned last year, or he's returned on 1st April of this year. He stays in India in entirety. Okay, so and then they've given about he's come back and returned permanently from Australia. That was the situation. They've given all the information relating to Australian income, the conversion rates, everything. But what happened, even though the person stays here for the full year and 365 days he stays here, because of that he's a resident. But in the earlier years, that not ordinarily resident condition, he had become a not ordinarily resident. He was not fulfilling the conditions for ordinarily resident. So he had become RNOR. Once you become RNOR, what happens? Only income which accrues arises in India, deemed to accrue arise in India, received in India, deemed received in India is taxable. In addition, income from business controlled or profession set up in India, that is taxable. Income arising outside India, which is not deemed to accrue arise in India, will not be taxable in his hands in case of a resident, but not ordinarily resident also. So what happened, many children had done it, maybe because they have given all the information in the question paper, let's make use of that information, and they have computed, including that Australian income, though the question will not require you to determine residential status. The question may simply require determination of total income or tax liability. But of course, the first step is to determine residential status, even if the question doesn't ask for that. So that you have to be very careful to determine the residential status first before proceeding to solve a question on computation of total income or tax liability. And as regards the time allocation you have to keep in mind, there are 4 case studies you have to answer out of 5, and so 4 hours you have. So basically it's 1 hour per case study, and that contains 40% MCQs, 60% descriptive. But you must take care your MCQs based questions, you must finish it in 15 to 20 minutes. The maximum 20 minutes if it happens to be very difficult, not beyond that. Remaining 40 minutes you have to keep for your 3 or 4 descriptive questions which can be asked for each case study. And when selecting a case study, I know it's one of the most difficult things in this paper. Challenging thing is which case study to leave. See, that it's very difficult to do it. That's a minimum amount of risk which you have to take, because what appears easy on the face may not be easy. What appears difficult also may not be as difficult as we think. See, sometimes the case studies may contain lots of information, but the questions may be relatively simple. So what we suggest to you in the reading time is to go through the questions most importantly, and then decide what case studies you're going to, which one you have to leave out. Basically, you have to decide which one to leave out. And then once you've chosen and you've started doing, thereafter, don't change your mind and do some other case study. What happens in such a case, you end up losing a lot of time, and you never know, the other case study also might be difficult, or you might be equally good or equally bad in that particular case study. But once you've made a choice in that 15 minutes time that this is the case study you're going to leave it, then go by it. It's okay. See, it's one choice. Even if you made a wrong choice, it doesn't matter. It's only a question of one question. Do the other questions properly. Even if you don't know 1 or 2 questions in the case study which you've selected, it's okay. But don't go and completely abandon one question and take up a new question. That it will result in too much of wastage of time, which you may not be able to afford in such an application-oriented paper like international taxation. So this is what I want to upper please.
Yeah, definitely. Time management is very crucial. You have 4 hours and 15 minutes. I don't think you will be able to read all the 5 case studies to understand you wish to, opt for to answer. So better to, go through the questions and then you decide upon. It is also possible this case study looks very difficult and the facts looks very difficult, but it is also possible that the questions based on those facts are not that difficult as it appears on face of it. So it's better to, I think it's my advice, it's our advice only, ki you go through your portions first, then you opt for it. So 15 minutes reading time utilize in that manner to make it, to choose the case studies which to answer, right? This is one thing. Then time management, 4 hours it's open book. Of course, it's an open book paper. So first impression in our mind is it's open book, then it's not necessary to, remember the things, to, memorize the things, but it's definitely for you, for the purpose of just only confirming whatever you are remembering, is it correct or not? You open your book. And otherwise, what will happen? You will keep on wasting a lot of time in searching the section, searching the information which is related to that particular provision. So it is better to do your full-fledged study, whatever you are doing for paper 7 also. But the benefit in this paper is just that you will be very sure that whatever rate you are taking, whatever due dates you are taking is correct. This will help you in this open paper. But otherwise, if you feel ki we will see then and there at the time of examination, then definitely you are going to waste a lot of time. You don't have that much of time in attempting this paper in 4 hours. Because in MCQs, basically my MCQs, what happens, it's very necessary for you to choose the correct option, and that is possible that you have to go through the facts very, very carefully. It might be possible some facts are given in first paragraph and some related facts are given in other paragraphs. Na?
So and some is part of the MCQ
itself.
So everything you have to consolidate.
To keep in mind along with the provision. So provision, if the understanding is better to you, then only you will be able to understand to answer it. Because facts ko also you have to interlink. Then only you have to answer. So this is the thing that you have to do a proper study also for this paper, even though it's an open book paper. Open book, it's beneficial. You will just go and rates in force. For example, schedule is given in the income tax. So you not to remember each and every rate, whatever the rates. Of course, but you have the idea. Yeah, this is the rate. For confirmation, you just open and see. Yeah, this is the rate. In case if you feel yeah, it's possible that it's maybe wrong or this thing. Or one more thing, don't as it is copy from the study material. The provision is not to copy as it is in your answer sheets. You have to understand what is the requirement of the question. Then only you should, then only you should answer it accordingly. What is the requirement? It should not be very lengthy and everything. It should be to the point answers they need from you. So see the requirements very carefully. Then you answer the, write the provisions, analyze the provision. Accordingly, you answer your questions, right? These are the tips, you have to be very careful that you have to do a proper study in this paper also. Time management is very, very crucial. These things, and what you have to, income tax rules, definitely you should take it with you. Income tax act and income tax rules are the things which you should take it with you in the examination hall, along with the other supplement of your publication, BoS publication. But income tax rules, there is no substitute for these things. You should take it. See, we cannot do anything out of syllabus, something like that in this paper. It may be from the income tax rules also. So you should take all these things with you. So these are the important things. You have to analyze the provisions, analyze the facts, analyze the requirement of the question, then you answer your questions asked in the case studies.
For supplementary, I would like to add something. It's divided into chapters in line with the study material so that you can easily correlate it. Amendments made the direct tax laws as amended by the Finance Act 2022 is relevant for May 23 and November 23 exams, and circulars notifications, the cutoff date is 31st October 2022. So do read your study material along with the supplementary. This is one thing which... any questions, please ask then and there. So we really feel it would be better if we are getting a feedback, if you followed whatever we are telling, or you have some further doubts, please raise your queries.
Yeah, make this session more interactive by asking the question. We also feel, yeah, you are understanding, you are, there. So please, whatever be the questions, you please raise us.
And even this regarding the preparation or writing the exams, what we have told you, in case you need some further clarifications for that, you can ask. Whatever, I mean, how to manage time management, we have told you. And don't attempt 5 case studies. Attempt only 4 case studies. What you are asked to do, only that much you attempt. Don't, because that itself is difficult. Strictly speaking, if you do that well, that itself, you need not waste time doing 5 case studies. 4 is enough, and keep 1 hour for each case studies. If suppose you are able to finish it 10 minutes before, that 10 minutes will be available for a more difficult case study. Yeah. So 1 hour is the maximum time. You can try to complete it by 50 minutes also, which will provide you grace time for the other questions. Okay. Now, how we have planned the things. Residential status, as I told you, is very important, because first and foremost, you have to know the residential status before you start answering any question. So regarding individual, now things have become quite complicated. Over the last couple of years, the amendments have come relating to different number of days stay, and deemed resident concept has been introduced. So we will be taking up residential status first. And after that, we will be taking up some important concepts in transfer pricing, like 94B vis-a-vis 92CE. And then thereafter, we will be taking the force of attraction rule, which is in model conventions, which is very important this way. And then we'll be doing equalization levy, significant economic presence, royalty, fee for technical services. Basically, we'll give a broad overview of some of the important aspects of international taxation. So can we proceed? to residential status. Residential status, what is most difficult is of an individual. So basically we'll be covering residential status of an individual, and thereafter the Black Money Act and the tiebreaker rule in the model conventions. Okay. So coming to residential status, why is residential status important? Why is it important? That we'll first go through, because that will determine the scope of your total income. There are, in case of an individual, there are 3 residential statuses: resident and ordinarily resident, resident but not ordinarily resident, and non-resident. See, whereas for a resident and ordinarily resident, global income is taxable. In this case of a resident, how to determine will be global income. So even an income accruing or arising outside India will be taxable in the case of a ROR. Even if you've received income outside India, if you, receipt and accrual is outside India, even then it will be taxable in the case of an ROR. Secondly, in case of a non-resident, let's go to non-resident. Non-resident may income accruing or arising outside India will not be taxable unless it is received in India or it is deemed to accrue or arise in India. Okay. So what is taxable in the hands of a non-resident? Income received or deemed to be received in India during the previous year. Income accruing, arising, or deeming to accrue or arise in India during the previous year. Yes, these 2 are taxable. But income accruing or arising outside India will not be taxable in the hands of a non-resident, unless it is actual receipt is in India or it is deemed to accrue or arise in India as per 9. Now coming to resident, but not ordinarily resident. Resident but not ordinarily resident, in his case also, it's more or less similar to a non-resident. Though the person is a resident, the taxability, the inclusions in total income are similar to a non-resident. That is, income received or deemed to be received in India, income accruing or arising or deeming to accrue or arise in India will be taxable in the hands of an RO and NOR. In addition, what will be taxable? Income from a business controlled from a profession set up in India. Income which accrues arise in India, but from a business controlled in a profession set up in India, then it is taxable in the case of an RNOR. Though that is not taxable in case of a non-resident. ROR case, everything is taxable. So we need not go into specifics. I hope this is clear. So to determine whether the income is includable in the total income, first, the residential status is very important. This is just to tell you the importance, why we need to know the residential status. Now, how do we go about determining whether a person is an resident, ROR, RNOR, or NR? Just give me a minute. Full screen is not appearing now. Let me take it like this itself. Okay. First, what are the 2 basic conditions for a person, individual to be treated as a resident? Number of days of stay in India, that is what is material for residency. He should have stayed in India 182 days or more in the relevant previous year. Relevant previous year in our case will be, the previous year will be 2022-23, assessment year will be 23-24. If he stayed for 182 days or more in the relevant previous year, then he would be resident. Okay. Or in case that is not fulfilled, at least 60 days he should have stayed in the relevant previous year plus 365 days in the 4 immediately preceding previous years. That is, previous year 22-23 he has stayed for 60 days or more, and in the earlier previous years, that is previous year 21-22, 20-21, 19-20, 18-19. These 4 years he should have stayed in India for 365 days or more. If this condition is satisfied also, the individual will be treated as resident for assessment year 23-24. But there are certain exceptions. What are the exceptions? An Indian citizen who leaves India in the relevant previous year, that is previous year 2022-23 in our case, for employment or as member of a crew of a ship. Suppose an Indian citizen is leaving India In the previous year, 2022-23, he's got some job in Dubai, so he's living in India. For what will be his residential status for assessment year 23-24? He will be resident only if he stayed in India for 182 days or more. The second condition will not apply to him for residency. Only the first condition will apply. Second condition will not apply. 63-65 days condition will not apply to such a person. Then, an Indian citizen or a person of Indian origin residing outside India ordinarily. He comes, visits India during the relevant previous year. Okay. And then he has total income excluding income from foreign source lesser than or equal to 15 lakh. Okay. In such a case, what a person, he can be an Indian citizen or a person of Indian origin. Who's a person of Indian origin? He or his parents or his grandparents have been born in undivided India. So such people are persons of Indian origin. And they are living outside India. They are coming to India for a visit. In that case, it's a visit, not returning permanently. They are visiting India. So in such a case, and their total income, excluding income from foreign sources, is lesser than equal to 15 lakh. So what do you consider total income excluding foreign sources? In income which accrues or arises outside India, which is not deemed to accrue or arise in India. That is income from foreign sources. That you have to exclude. So all the remaining income is what? Income received in India, deemed to be received in India, income accruing or arising in India, income deemed to accrue or arise in India, all these four, plus income from a business controlled from India or profession set up in India. That also you will consider. And if that income is less than 15 lakh, then only the 182 days condition will apply in case of that person also. The 60 plus 365 days condition will not apply in case of such person. Then third one is same thing, Indian citizen or a PIO residing outside India, visiting India again during the relevant previous year, having total income, excluding income from foreign sources greater than 15 lakh, greater than or equal to, greater than 15 lakh. In such a case, what will happen? The 182 conditions will apply, plus the 60 plus 365 days condition will apply in a modified form. That is, he should have stayed in India not for 60 days, but 120 days in the relevant previous year, 2022-23, and 365 days or more in the 4 immediately preceding previous year. So if this condition he satisfies also, this person becomes a resident. That is, an Indian citizen or person of Indian origin residing outside India who comes to India on a visit, and his total income excluding income from foreign sources is greater than 15 lakh. In that case, the modified condition of 120 days plus, if suppose the stay is not 182 days, then you have to see if it's greater than 120 days. If it's greater than 120 days, that alone will not suffice. He should have stayed in India for 365 days or more in the immediately 4 preceding years. Only then he will be treated as a resident of India. Okay, so this is clear. These all relate to, these are all conditions given in 6.1 itself, section 6.1. Now suppose say that the person is not a resident. He becomes a non-resident by virtue of 6.1. Then you have to see whether the person is a deemed resident as per 6.1a. What is deemed resident? An Indian citizen whose total income, excluding income from foreign sources, is greater than 15 lakh and who is not liable to tax in any other country. Okay. Let us take an Indian citizen has gone and settled in some country, country X. He's gone and settled there. He settled in country X. So what happens? In such a case, how do you see? He's not come to India after that at all. Okay. So by virtue of number of days stay, he is a non-resident because he's not visited India also. But if suppose country X does not levy tax on its income, does not levy, then you have to see whether he's a deemed resident in India as per 6.1a. How will you see that? His income from Indian sources, that is income received in India, deemed to be received in India, accrues or arises in India, deemed to accrue or arise in India, or profits and gains from a business controlled from India or profession set up in India. This, if it exceeds 15 lakh and he is not liable to tax in country X, then he would be deemed resident in India, even though he might not have stayed in India even for a single day. Actually, as per 6.1, the number of days of stay becomes important. But if you become non-resident by virtue of 6.1, then you have to go to 6.1a and see if you are a deemed resident. Deemed resident will always apply only to an Indian citizen. Okay, if he's simply a person of Indian origin, you can't apply the deemed resident provision. It's only in case of an Indian citizen whose total income, excluding income from foreign sources, is greater than 15 lakh. And he is not liable to tax in any other country. I hope this is clear. Now, this is for as far as resident is concerned. Now, we have to see whether the person is, how is a person not ordinarily resident. Additional conditions under determining whether we saw the three residential status, ROR, RNOR, and non-resident. 6.1 helps you to determine, 6.1 and 1A help you to determine whether the person is a resident or a non-resident. After that, how do you go about finding whether the person is an ROR or RNOR? So the additional conditions become important. Additional conditions are, individual should have stayed in India for 730 days or more in the 7 immediately preceding previous years. That is, prior to the preceding years, 7 immediately preceding years, stay in India for 730 days or more, and resident for 2 out of 2 years, more than 2 or more years out of the 10 immediately preceding previous year. Read it very carefully. Greater than or equal to 730 days in the 7 immediately preceding previous year, and resident for 2 years or more out of the 10 immediately preceding years. If both conditions are satisfied, then he is an ROR. This condition also should be satisfied. This condition also to be satisfied. Only then he is an ROR, and his global income will be taxable. Otherwise, it's an RNOR. So that means if he satisfies any one of the conditions, or he does not satisfy both the conditions, then he would be RNOR. Okay. This is in all the cases, but there are in 2 cases where a person by default would be treated as RNOR without seeing the additional conditions. Which are those 2 cases? One is a deemed resident case, 618 deemed resident case. He will be deemed as a resident if you satisfy this condition. Indian citizen whose total income exceeds 15 lakh and who is not liable to tax in any other country. He is deemed as a resident. He is deemed as a resident but not ordinarily resident. Okay. So when you are deemed as a resident, he'll become resident but not ordinarily resident. So the only additional income which will be taxable in his hands, in addition to income accruing arising in India or received in India, deemed to be received, deemed to accrue arise in India, additional income which will be taxable in the hands of a deemed resident is income from a business controlled from or profession set up in India. Okay. Which is, even if it's received outside India, will be taxable in the hands of a deemed resident. Okay, because by default, he's a not ordinarily resident. Likewise, where a person becomes a resident, Indian citizen or person of Indian origin residing outside India, who comes to India on a visit during the previous year, total income greater than 15 lakh. Okay, his stay in India is not for 182 days, he stayed in India for 150 days. First condition, he is not satisfied. Second condition, he might have satisfied. Stay in India for more than 120 days, plus you have to check 4 immediately preceding years. If 4 immediately preceding previous years is less than 365 days, then he does not become a resident, even though he might have stayed in India for 120 days or more. Suppose somebody stays in India for 150 days in the current previous year. Okay, the person who, Indian citizen or person of Indian origin who residing outside India visits India for 150 days. Okay, then he falls under this, but you have to check the 365 days condition also. Earlier 4 years he's there only for 200 days. Even if he's in India for 150 days, then this condition will not be satisfied. Then he'll be treated as a non-resident. Okay, but if he's satisfying this condition, he stayed in India for 120 days. Earlier 4 years, he stayed in India for 400 days. So he's satisfying the second condition. Then here again, by default, he would be treated as resident, but not ordinarily resident. There's no need to see the additional conditions, satisfaction of additional conditions. However, if this person becomes resident by virtue of condition number 1, 182 days, then you have to see the satisfaction of additional conditions, both the additional conditions. See, this provision is the basic in international taxation. You have to understand this properly, because by virtue of the residential status only, whether the income is includable in his total income or not. We have seen many cases where such questions are asked. The person is RNOR or non-resident, but income has been given, outside India has been given. And because the TTBR rate, everything has been given so extensively, students tend to compute the total income by including such income, whereas that income will be excluded because that person is an RNOR. So determining residential status is very, very important. So here we've just, the notes only gives section 6.1a would not apply. Suppose a person is resident as per section 6.1, then there's no need to apply deemed resident provision under 6.1a. Only if the person is a non-resident, then you will have to apply 6(1)(a) provision. Non-resident, as per 6(1), you have to apply the deemed resident provision. And income from foreign sources, as I've told, it's income which accrues or arises in outside India, which is not deemed to accrue or arise in India, except income derived from a business controlled in or profession set up in India. That we know. That if it's income from a business controlled or profession set up in India, for the purpose of determining that 15 lakh threshold limit, you have to consider that also. Income from business controlled from India or profession set up in India. Please ask your doubts. Are you clear? At least answer this question. Are you clear with the concept of residential status? Because I'll be proceeding to black money, residential status under black money now. Please let us know whether you have followed this, any doubts in this particular portion. We are looking forward to your participation. So if there is no query, I will take that everybody has understood. Okay, I'll proceed to black money. In case you have your query, please send it to us. Before that, we will solve a question also based on whatever we have thought now. Okay. Mr. Akash, currently aged 40 years, is an Indian citizen who left for USA in the year 2009 for employment in Microsoft. He visited India for 15 days every year up to 2018-19. Okay, so he's now in USA. He's visiting India. He's an Indian citizen who is outside India. He is visiting India for 15 days every year up to previous year 18-19. He resigned his job in Microsoft and returned to India with his family on 15/2/20 permanently. He is returned to India permanently on 15/2/2020 and opened a startup in Pune on 1/3/2020. He left for USA on 31st March and returned on 1st August in the calendar years 2020 and 21 for business purposes. See, he came to India permanently in 15th February 2020. After that, in the calendar years 2020 and 21, he left India on 31st May and returned on 1st August for business purposes. He has made a visit to USA these 2 years for a couple of months. So June, July, August for 3 months for business purposes. Okay. So he has a house property in Dallas, USA, from which he gets a rental income of $2,000 every month. Okay. And which was credited to his savings bank account in Dallas. He paid municipal taxes of $200 in December 2022 out of the said account. That is out of the savings bank account in Dallas. Interest of $150 was credited in the said bank account, that is bank account in Dallas, in March 23. In the previous year, 22-23, he earned a business income of 26 lakhs from his startup venture in Pune, in addition to interest on FD of 1,70,000 from State Bank of India, Pune branch. He deposited 1,50,000 in a 5-year term deposit with Bank of India, Pune branch, out of rental income earned by him in USA. Compute his tax liability for assessment, rounded off for assessment year 23-24, assuming that the value of $1 is rupees 79 throughout financial year 22-23, and he does not opt for section 115 BAC. So here, what the question is asking, compute his tax liability. So what must we do first? We must straight away proceed to compute his total income? No. First, we have to know what is the residential status of Mr. Akash. Okay, this particular year's previous year, for that we have to do the computation. Current year, how long he is staying? Current year, he is staying throughout the year because he has returned to India permanently on 15/2/2020 he is returned. Then he left for USA for 31st May and returned on 1st August in the calendar years 2021 for business purposes. So in calendar year 22-23, they have not given anything. So calendar year 22-23, he is in India for 365 days. So 365 days, which is greater than 182 days. And so he becomes resident under section 6(1). This is very easy. He is resident because he stayed in India throughout the previous year. But what should we find out? 180, since he satisfies the 182 days condition, I need not check 60 plus 365 days condition in his case. Because he's not coming to India for a visit. He's come back to India permanently. And that too 2 years back he's come back permanently. So this year, both the conditions I can see, either 182 days condition or 60 plus 365 days condition. Since he's satisfying 182 days conditions itself, I need not go into 60, 365 days condition. So he stayed in India for greater than 182 days. Now to find out whether he's an ROR or RNOR. R is clear, but ROR or RNOR. I need to find that out. Then only I can compute the total income and tax payability. I have to see what are the conditions. Stay in India for 730 days or more in the 730 days or more in the 7 years immediately preceding the relevant previous year. These are the 7 years immediately preceding the relevant previous year, 21-22, 15-16 to 21-22. And the residential status, resident in 2 or more years out of the 10 immediately preceding previous years. That also we can find out. Now let us take the number of days of stay. Previous year, 21 and 22 and 2021. These 2 years, he was in India only, but he left for USA on 31st May and returned on 1st August. So these 2 days we have to consider these 2 days as stay in India. What is the time in between? From 1st June, 30 days in June, July, 31 days, June and July, 61 days. He was not in India. So total number of days in these 2 years is 365 minus 61. So that will be 304. There was no leap year, I think, in between. Leap years previous year 1920 is the leap year, no? For not 21, 22 and all. So 365 minus 61 days he was in USA in these 2 years. So 304 days he stayed in India in these 2 years. 304 days. 300 this is 0. It's coming like 304 days in these 2 years. Then 1920 is the year in which he came back to India. He came when on 15 to 2020 he had come. So in March he stayed in 31 days and February he stayed 14 days. That is 28 minus 15. So that 50 from 15th August. So 15th to 28th is 14 days and 31 days in March. So it's 45 days here. So previous year 1920 he has stayed for 45 days. Prior to that, up to previous year 1819, he was there in US and he had visited India for 15 days every year. So up to this it's 15 days every year. So now what is the total number of days? So it's 304 plus 304, 4 plus 4, 8, 5 5s are 25. 5 5s are 25 plus 8, 33. 3 plus 4, 7 plus 4, 11. Carry 1. Carry 1. 3 plus 3, 6 plus 1, 7. 713 days in total. So you understood this? Last 2 years he visited in USA for 61 days. So that I am reducing. So you have 304 days in previous year 21-22, 304 days in previous year 2021 because he visited USA in the month of June and July he has visited USA. So for 61 days he's visited USA in these 2 years, which I reduced from 365 days. So I get 304 days in these 2 years. 1920 is the year in which he came back to India. So from 15th to 2020, I have to take from that to 31/3/2021. That is 31 days in March and 14 days in February, 45 days. So previous year 1920, it's 45 days. Till that, previous year 1819, he was there in Microsoft and he was visiting India only for 15 days every year. So 15 in the 4 immediately preceding. We have to see 7 years. Na? So 4 years, it is 15 days. So total of these days from 304 to 15. From previous year 21-22 to previous year 15-16 is 713 days. 713 days is less than 730 days. So one of the conditions he is not satisfied. So you need not actually see the other condition itself. See, either one, you have to satisfy both the conditions for being treated as an ROR. He is not satisfied the one condition, number of days of stay itself, he is not satisfied. So he becomes an RNOR. If you want to see residential status, this year he'll be resident because he's there for more than 182 days. Here 2 years Here also he's a resident because he stayed for more than 182 days. Otherwise, other years he will be non-resident because he doesn't satisfy the condition of stay in India. So these two, so resident in 2 or more years out of 10 years, he is satisfying that condition. But still, to be an ROR, you have to satisfy both the conditions. Stay in India for 730 days or more, plus you are a resident in 2 or more years out of the 10 immediately preceding years. So even the early, after years, he'll be non-resident only. But this, because he's resident in 2 years, he satisfies the other condition. But only one of the two conditions he satisfies. If he satisfies one or none of the conditions, then he is a RNOR. In this case, he's an RNOR because his stay in India is for less than 730 days in the 7 immediately preceding previous year. So, but even though he satisfies the second condition, he doesn't satisfy the first condition. So he's an RNOR. And in case of an RNOR, what happens? Which income is includable? Income accruing arising in India, income received in India, income deemed to be received in India, and income deemed to accrue arise in India, plus profits from business controlled in India or profession set up in India. Income which accrues arises outside India, but which is not received in India and is not deemed to accrue arise in India will not be taxable in the hands of Mr. Akash because his residential status for previous year 2022-23 is RNOR. So what is the income which will be taxable? Sorry. Income which will be taxable in his hands will be RNOR. He has a house property in Dallas from which he derives rental income of $2,000, which was credited to his savings account in Dallas. It's not brought into India. He's not received it in India. He's received it abroad. So that income is not taxable in case of an RNOR. Municipal taxes. So if the income is not taxable, municipal taxes which is paid, you can't claim as deduction. Interest of 140 was also credited to the said bank account in Dallas in March 2023. That again won't be taxable in his hands, be it an RNOR. He earned a business income of 26 lakhs from his startup venture in Pune. Yes, that is taxable because it's in Indian income. In addition to interest on deposits of 1,70,000 with State Bank of India. So these two are his income, 27,70,000 Indian income minus deposit out of, in a 5-year term deposit with Bank of India, out of rental income earned by him. It doesn't matter. It's not necessary that you have to do it out of your Indian income. So that deduction you can claim 1,50,000 for PPF under ATC. So this will give you 26,20,000, your total income of Akash. Income earned outside India is not taxable in his case because he's an RNOR. So 26,20,000, what is your tax liability? So up to, he's not opted for BAC. So 16,20,000 into 30% will give you 16,20,000 into 30% is 4,86,000. $4,86,000. This is 16,20,000 into 30%. Up to 10 lakh, it is 1,12,500. 20% plus that slab rates which you apply. It will be 598,500 plus cess of 4%. Into 500. 598,500 into cess of 4% will be 23,940. Plus 598,500 is 622,440 is the tax liability. This is the tax liability. It's only the Indian income. Actually, the answer is very easy. But what is time consuming here is to determine the residential status. Because if I had not determined residential status, I straight away thought he stays in India for 365 days. And so he's a resident, and I add the Australian income and everything, my answer would be completely wrong. I wouldn't have got this particular answer. the trick here is to find out, though he's resident, he stayed in India for 365 days, is he a resident but not ordinarily resident? If he's a not ordinarily resident, then his income earned outside India and Australia, in Dallas, USA, that will not be taxable in his hands. Only the Indian income will be taxable, and income from business set up in India, business controlled from a profession set up in India. There's no information relating to that in this question. But if there had been information, that income also would be included in the hands of a resident but not ordinarily resident. I hope it is clear. We are waiting for your queries. Who is going to be the first person to ask a query? Please raise your query. So now we have understood as per the Income Tax Act. Let us see the relevance of residential status under the black money law. Black money law seeks to bring to tax undisclosed foreign income or foreign asset. Okay. Who is a resident? Who comes within the scope of the black money law? Any person resident in India. Okay. First, the rate of taxation is 30% on undisclosed foreign income and asset of the previous year. Undisclosed asset located outside India shall be charged on its value the previous year in which it comes to the notice of the assessing officer. And Black Money Act came into effect only from assessment year 16-17. That you have to know. Undisclosed asset outside India, the year in which the assessing officer discovers it and he issues a notice, it will be brought to tax in that year. Whereas undisclosed income will be brought to tax in the relevant year in which it was earned. So this is the difference in taxability of undisclosed foreign income and undisclosed foreign asset under the black money law. Now, who are the assessees who come within the purview of the Black Money Act? A person being resident in India within the meaning of 6 of the Income Tax Act in the previous year, relevant previous year. You should be resident in India. Or being a non-resident or not ordinarily resident within the meaning of 6(6). Who was resident in India either in the previous year in which income referred to in section 4 relates, that's the undisclosed income. Previous year in which the undisclosed income was earned, or the previous year in which the undisclosed asset located outside India was acquired. Okay, you read this definition very, very carefully. See, normally in the normal course, when in the first clause itself resident is covered, in the Income Tax Act, you think resident means, if simply you mention resident ordinarily resident, resident not ordinarily resident, both are covered. However, here you notice not ordinarily resident is being included along with non-resident. So in the very first clause, they intend to cover only ROR. Combined reading will depict the very first clause, they want to cover only ROR. Second clause, if you are a non-resident or a not ordinarily resident in this year, then you have to see whether in the previous year in which the undisclosed asset was income was earned or undisclosed asset was acquired, in that year, whether you are a resident. In that year, if you are a resident, even then you will come within the purview of the Black Money Act, even though currently you are a non-resident. Currently, I don't live in India, I've gone abroad, I've settled in some country. But you can still be brought to tax under the Black Money Act if you were resident in the year in which the undisclosed income was earned or the undisclosed asset was acquired. So that is very important. Your current year residential status, if you are a resident, you immediately come within the purview of the Black Money Act. You need not check then you need not go ahead and check whether you are resident in those years when you acquired. If in the current year itself you are a resident. But in the current year, if you are non-resident, if you are a resident but not ordinarily resident or a non-resident, then you have to go back and see the previous year in which the undisclosed income was earned or undisclosed asset was acquired. In that year, if you are a resident, once again you come within the purview of the Black Money Act, even though you are non-resident in this year. See, there is a section 72C which states that for an assessing officer to issue notice in respect of an undisclosed foreign asset, then it will be brought to tax. That value of undisclosed foreign asset will be brought to tax in the year in which the assessing officer issues notice. For that purpose, 72C says that it is deemed to be income of that previous year. But for the purpose of determining whether an assessee is, whether he comes within the purview of the Black Money Act, for this purpose of this clause, you have to consider actually the year in which he acquired the undisclosed asset and not the year in which it will be subject to tax for this particular purpose. I hope this is clear. I have to see the year in which, suppose current year I'm a non-resident. Okay. Then I have to see, suppose undisclosed foreign asset was acquired in 2018-19. In this year, if I was a resident, then this person comes within the purview of the Black Money Act. However, when suppose I issue notice for assessing undisclosed asset he acquired in the previous year 18-19, when the assessing officer issues notice in 2022-23, it will be taxed as income of 2022-23 only. Because there's a special provision for undisclosed foreign asset. It is not there for undisclosed foreign income. For foreign income, it will be the year in which the income was earned. I hope this is clear. Now let's take up a small question in this regard. We are just trying to say how the residential status is important even under other laws. After this, we will see the model convention also. So, Miss Diana as shareholder. Miss Diana, a shareholder of Statue Limited, is an Indian citizen. Okay, let me mark the key. Who ordinarily resides in country E. However, up to 31st March 2020, she was residing in India. So, up to previous year 1920, she was residing only in India. From previous year 2021, she is staying in country E. Okay. And she used to visit India till previous year 29-20. She used to visit country E for 60 days every year for business purposes. Okay, out of 365 days, she used to stay in India for 305 days, and country E she used to be visiting for 60 days for business purposes. Thereafter, on 1/4/2020, she went to country E for business purpose and settled there. So from 1/4/2020, she settled in country E. Country E levies tax at a flat rate of 25%. She visits India from 1st September to 30th November every year. She is visiting India. She is an Indian citizen who is visiting India. Okay. She purchased property worth 25 lakh in country E in the previous year 1920. Up to previous year 1920, Diana was in India only. So she was resident in India. Resident and ordinarily resident in India. Up to previous year 1920. Okay. Only then 1/4/2020 only she went to country E, and thereafter she settled there permanently. Till that time she used to go there only for 60 days in a year. So she used to stay in India for 305 days. So she is definitely a resident and ordinarily resident up to 1920. Okay. Now this asset came to the notice of the assessing officer. This country E ka flat, she visits country, she purchased property worth 25 lakh in country E. That came to the notice of the assessing officer only in March 2023. Diana could not disclose the source of income for this said purpose. So it's an undisclosed foreign asset. Can Diana be subject to tax under the Black Money Act in respect of the undisclosed foreign asset which has come to the notice of the assessing officer? Okay. Now let us see Diana, what happens to her current year. She is a non-resident because she is not come to India in previous year 22-23. The question says from 1/4/2020 she went to country E for business purposes and she settled there itself. That means she is not come to India. There is no other information relating to her stay in India. So current year she is a non-resident. For previous year 22-23, she used to visit India for 60 years. Thereafter, she visits India from 1st to September to 30th November every year. Okay. So in previous year 22-23 also, her visit is from 1st September to 30th November. So 1st September, October, November. So 91 days she is visited India the current year. It's not, no, I just missed that out. I said no, she has not visited India at all. It's not like that. She comes and stays in India for 91 days. But what is she? She is an Indian citizen who ordinarily lives in country E. She visited India for 91 days every year. After 2021, she's been visiting India for 91 days. So, an Indian citizen who ordinarily resides in country E and who is visiting India, what are the conditions for determining residency in her case? Let's go back to the chart. Indian citizen or PIO outside India visiting India. Okay, we don't know what is her total income. Have they given information relating to her income? No. One second. They have not talked about her income in country. So let's not go by that. we'll just see. Anyway, she's visiting India. Minimum days of stay she will require even for this condition to apply is 120 days in the current previous year. But she stayed only in 90. We do not know whether she falls in this bracket or this bracket because the information relating to that is not given. Indian citizen or PIO residing outside India and visiting India during the relevant previous year. So, since this income is not given, but at the same time we see that 60 days and 365 days condition will definitely not apply to her. It may apply to her in a modified form if her total income is exceeding 15 lakh. So even if it applies in the modified form, it will be 120 days minimum days of stay will be required in the previous year. Since her number of days of stay is less than 120 days, she is a non-resident. 182 days she definitely does not fulfill. She was there only for 91 days. No? So first condition, definitely she will not be fulfilling 182 days. Second condition also, in this case, it will not apply at all. If her income is less than 15 lakh, second condition will not apply. If income is greater than 15 lakh also, 120 plus 365 days condition would have applied to her. But since her number of days of stay is only 91, she won't satisfy this condition also. So she is a non-resident. Diana is in India only for 91 days, which is less than 120 days. So she's a non-resident. Suppose hers had been above 120 days, then the total income figure would have been relevant, because only with the help of the total income I would see whether the second condition is applicable. Then we have to see 120 plus 365 days. But here, since it's 91 days, even below the threshold of 120 days, there's no need to go into other factors. You should see which information is available in the act. Question now, which. In this case, that income information is not available, number of days of stay is available, and it happens to be less than the minimum days required, less than 120 days. So she stayed in India for 91 days. She is a non-resident for previous year 22-23. So one of the conditions, now coming to black money. Black money, you have to be, first condition is not satisfied. Being a resident in India within the meaning of 6.6, that condition she has not satisfied. Now go to the second condition. Being a non-resident or not ordinarily resident. She is a non-resident in the previous year. Who was resident in the previous year in which the undisclosed asset located outside India was acquired. When was that acquired? In the previous year 1920. She purchased property for 25 lakh in the previous year 1920. Previous year 1920, she was very much resident in India. For the first time, she left to India permanently only on 1/4/2020 to country. Till that time, she was visiting country only for 60 days. Her stay in India during those days were 365 minus 60, 305 days in the previous year 1920. So she is a resident in India in that year. So because she is a resident in India, assessing officer. What is the thing? Can Diana be subject to tax? Yes, she can be subject to tax because she was resident in previous year 1920, being the previous year in which the undisclosed foreign asset was acquired by her. So which of the four options are correct? No, since she is non-resident. No, this is not correct. Yes, she is a non-resident, but by virtue of being a non-resident, that alone you can't say that Black Money Act will not apply to her. It will apply to her if she was resident in the year in which the asset was acquired. Yes, she is resident in India in the previous year 22-23, having stayed in India for more than 365 days. And this statement is also wrong. She is not resident in India in the previous year 22-23. This 63-65 condition will not apply to her at all. Yes, she is resident in India the previous year 1920 being the year in which the foreign asset was acquired. Yeah, this is the right answer. Because what is the question? Can Diana be subject to tax under the black money law in respect of the undisclosed foreign asset which has come to the notice of the assessing officer? Yes, because in the year in which the undisclosed foreign asset was acquired, in the previous year 1920, she was resident in India because she was there in India for 305 days in that year. Only thereafter she left for country. So she can be taxed in the current year because current year is the previous year 22-23, and this value of undisclosed foreign asset will be deemed to be the income of previous year 22-23. Okay, but what we have to consider for the purview of Black Money Act, she was a resident in the previous year in which the asset was acquired, even though this value of the asset is going to be subject to tax in the previous year 22-23 when he was non-resident in India. Okay. Yes, she is resident in India both in the previous year 1920 and 22-23. This is wrong. She is not resident in previous year 22-23. In this year, she was non-resident since she stayed in India for less than 120 days. So the correct answer is yes, she is resident in India the previous year 1920, the year in which the undisclosed foreign asset was acquired. So because of that, she comes within the purview of the black money law. Assessing officer, he is issued notice in 23 and he can bring to tax the value of the property in the assessment year 23-24, previous year 22-23 and assessment year 23-24. I hope this is clear. We'll proceed to the next one. Here again, we are going to talk only about residential status. But see, India has a DTA with some country. Let us say country A. India has a DTA with country A. And as per the DTA with country A, so we have to see, in India, the person is a resident because he stayed in India for more than 182 days. Suppose as per the tax laws of country A also, he's a resident of that country. Okay. Then how do you go about? He's a resident of two countries now. Resident of India and resident of country A. How will you determine which country he is a resident? So you have to apply the tiebreaker rule. As far as residency condition in model tax conventions and DTAs, they say you have to be a resident as per the domestic tax laws. If you are a resident as per the domestic laws, by virtue of which you are liable to tax, then you have to consider you'll be a resident in that country. So now in our questions, what happens if the person is a resident? Then they will be liable to tax in India. If suppose a person is a resident in India, he'll be liable to tax in India in respect of his global income. Likewise, if the person is a resident in country A, he will be liable to tax in global income in country A. Then you have to apply the tiebreaker rule. In such a case, you have to apply the tiebreaker rule. If you're not a resident in India, suppose you're a non-resident in India, then only income from Indian income will be chargeable to tax in your hands. Now, in that case, tiebreaker rule is not required. But if you're a resident in both the countries, two countries, then you have to apply the tiebreaker rule to see actually which country he is a resident. I hope this is very clear. The question below will make you clear on both the things. Suppose a person is a resident. I am talking about a case where a person is a resident of India and another country. Then you have to apply the tiebreaker rule. Okay. Now, suppose he is in India for 184 days. He is in that country for 180 days. There, the country A, he becomes a resident if you stay in India, stay in country A for 180 days or more. In India, it's 182 days or more, or the other condition, whatever. Now, suppose he stays in India for 184 days and in country A for 180 days, then he becomes a resident of both countries. Then, if there's a DTA between India and country A, the DTA provides Article 4 of the DTA is on determining residency. If you're a resident of both the states, then you will have to see as per DTA in which state you are a resident, which state which country you are a resident. First, you have to see the first condition is permanent home. Now, let's say we are talking about one Mr. Anand. Okay, Anand stays in India for 184 days. Anand stays in country A for 180 days, 181 days. 365 days. No? So 181 days. So he is a resident of both countries. Now, what do we see? Where he has a permanent home. Suppose he has a permanent home in India and he does not have a permanent home in country A, then he'll be resident of India and not country A. What is a permanent home? Permanent home is any place where the dwelling house which is available to Mr. Anand. Now we are talking about the case of Mr. Anand. It becomes easier to refer. Anand has a house in Delhi. Anand has his own flat in Delhi. But he does not have a house in country A. Then he will become resident of India by virtue of the first thing, permanent home condition. Okay, but what is a permanent home? It can be an accommodation which I own, and it can be an accommodation which I have taken on rent. It will be available to me all times. So permanent home can also be a rented accommodation, an accommodation which I have taken on rent. That can be a permanent home. But accommodation, with my own accommodation, if I've given it on rent to somebody else for 3 years, then that will not constitute a permanent home because that is not available to me for my stay. I've already given it out on rent to somebody else. So if I've rented out my property, and I have only one property, I've rented it out, that will not constitute my permanent home. Permanent home is my own house, which is available to me for living, or a house which I've taken on rent, and I'm paying the rent for that house, that is also available to me for living. So that can also be a permanent home. But if you're going for a short stay, you're staying in a hotel or something for a few days, then that is not a permanent home. So we have to see whether the person has a permanent home in India. If he has a permanent home in India, but he does not have a permanent home in country A, then he'll be resident of India. But suppose he has a permanent home in India and country A, both places, then we have to move to or he doesn't have a permanent home in both places. Then you have to move to the next condition. He either has a home both in India or country A, or neither in country A or in India. In that case, you move to the second condition, center of vital interest. Vital interests is the place where your interests lie, your personal and economic interests lie. See, what is personal or economic interest? My family. Suppose this Mr. Anand's family is in India. Okay, his parents, his wife, his children are all in India. Then, even though he has a permanent home in both the places, he will be considered as resident in India. If he has a family in India, or he has some cultural relations, he gives concerts in India, he has some cultural relations in India, or he has a property which is rented out, that will come under the second category. He has a property which is administering in India, then that means the center of vital interest is in India only. But suppose he has center of vital interest in both country A and India, or he doesn't have center of vital interest in both the places. In such a case, you go to the third one, habitual abode. What is habitual abode? Habitual abode is the number of times, frequency of stay in India, duration of stay, or countrywide. I'm just telling India, frequency of stay in a country, duration of stay in a country, that is your habitual abode. So there you have to determine that, whether that is there in, here the purpose doesn't matter. How many times I visit, whether it's for my personal purposes, whether it's for business purposes, that is irrelevant. But I'm frequently visiting India, I'm staying here for a long time, then you determine the habitual abode. That you will have to determine whether that is in India or in country A. If both the conditions are, if it's there in both places or if it's not there in either place, then you have to see the nationality. Suppose he's an Indian national, then he is resident in India. Because all the three conditions we are not able to determine. Either he has permanent home in both places, or he does not have permanent home in both places. You come to the second condition. This is the order which you will have to follow. First, permanent home. Second, center of vital interest. Third, habitual abode. Fourth, nationality. And then, in a rare case where a person is a national of both states, then you have to go to the mutual agreement between competent authorities. When all these conditions, it is not possible to determine, then you go for the final condition, mutual agreement between competent authorities. We have a question for this, which will help you understand this in a better manner. Okay. Mr. Arjun, aged 52 years, carries on business in Mumbai. Carries on in Mumbai business of trading in spices, grown in his own spice gardens at Munnar. Okay. He also has spice gardens in country Z, and he derives income from country Z also from sale of spices. Okay, he carries on business in Mumbai, trading of spices, owns spice gardens in Munnar. Okay? He also has spice gardens in country Z, and he derives income from country Z from sale of spices grown therein. He stays in India during the entire month of May, July, September, November, January and March. He stays in country Z during the month of April, June, August, October and December. As per the domestic laws of country Z, he would be resident of that country if his stay in India is 180 days or more. So country Z, as per country Z, if he's staying there for 180 days or more, he's resident in that country. In India, it's 182 days condition or 60 plus 365 days condition. Now let us see the number of days where he stays. India and country Z. Okay. India mein he stays in India during the entire month of May, July, September, November, January, March. This is India. Then country Z, April, June, August, October, December, plus February. Okay. So India, how long he's staying? 36 or 180 plus 4, 184 days he stayed in India. Here it is 60, 120, 150, 130, 30, 60, 90, 120, 150, 150 plus 30, 180, 181 days. This is 365 minus 184 will also give 181 days. So now what happened? As per India, is he a resident? Yes, he stays in India for greater than or equal to 182 days. So he's a resident of India as per the domestic laws of India. Country Z also, what is the residency? Rule for residency. As per domestic laws of country Z, he would be resident in that country if his stay in that country is for 180 days or more. He stayed for 181 days in country Z. So he's a resident of country Z also. He's a resident of India also. He's a resident of country Z also. Now, so we have to apply the tiebreaker rule. So what is given relating to the tiebreaker rule? Arjun owns a flat in Juhu where he lives with his wife, 2 children and his parents. Okay, he owns a flat, so the permanent home is available to him in Mumbai where he is living with his children. He also owns a flat in Thane which is let out. So flat in Thane which is let out is not a permanent home because it's not available to him, but he has a permanent home in Juhu, Mumbai. That is enough. He owns a residential house in country Z where he stays when he visits country Z. There also he has a permanent home. See, he has a permanent home in India, Juhu, Mumbai. He also owns a residential house in country Z where he stays when he visits country Z. So permanent home he has in both places, India and country A. So what should we do next? We have to see the second point, center of vital interest. So what is information given relating to that? So center of vital interest, you have to see what other information is given. Okay. Mr. Arjun is a passionate artist and he can showcase his painting in art exhibitions in Mumbai. That is India. He earned interest of 42,300 deposit with savings bank account in SBI. He deposited 1,50,000 in PPF, paid medical insurance premium to ensure the health of his health and that of his spouse. He also paid 32,000 to ensure the health of his parents who are residents in India. All payments were made through account payee check. Okay. Now, permanent home he has both in Juhu, Mumbai, he has in India, and he has a residential house in country Z. So we are going to the next one, his center of vital interest. Okay. His center of vital, he's a passionate artist and has showcased his paintings and art exhibitions in Mumbai. So cultural interest he has in India. His family is in India because they live. He owns a flat in Juhu in Mumbai where he lives with his wife, 2 children and his parents. So family is in India. Cultural relations are in India. He also owns another property in India. Where is it? He owns a flat in Thane which is let out. He has a property in India which he is administering. Thane flat, that is also in India. So all these things show that his interest, social and economic interest, personal and economic interest are in India. That is not in country Z. Permanent home is available in both places. As per the domestic laws of India, he is resident in India. As per the domestic laws of country Z, he is resident of country Z. Thereafter, so we have to apply the tiebreaker rule. He is resident of both the countries. First condition, we'll have to see permanent home. India, he has a permanent home. Yes. He has a permanent home in country Z. Yes, he has a permanent home there also where he goes and says India, it's Juhu. He has. So both countries he has a permanent home. Then go to the next rule, center of vital interest. There we see he has cultural interest in India because he has showcased his paintings in India. His family lives in India. So that is also a tie in India. Then he has a property in India which is let out for which he has let out. From that also he is deriving interest. So he has personal interests are closer with India. Here we are not considering the tea garden part because that also he has both in India as well as in country Z. He owns spice gardens in Munnar. He owns spices gardens in country Z also. So that point when both countries have, India doesn't have that cannot be the basis for telling. Base can be a cultural, family and as well as a land property in Thane which is let out. So by virtue of all this, the second tiebreaker rule, center of vital interest, that will apply and he'll become a resident of India. Then you have to compute the total income. That, of course, they've not asked for in the question, but you can go about computing because he's a resident in India. You have to take his global income and see there. Thereafter, if any income is exempt by virtue of the DTA, you must provide for the relevant tax credit. As of now, by this question only requires you to determine the residential status. So, since he is resident in India, as per the domestic laws of both countries, tiebreaker rule will apply. Permanent home in both countries. Thereafter, center of vital interest is in India. So he is resident in India by virtue of the DTA between India and countries. So this is how we've seen how the residence rule apply under the Income Tax Act. What is the relevance to determine the scope of total income? How it is relevant in the context of black money law and model conventions. How you have to apply the tiebreaker rule under the model conventions. Any queries? I would encourage you to post your queries. If any point is not clarified, we'll clarify it to you again. Please post your queries. Otherwise, in the absence of it, we will take that you've understood everything. Now, let's go to the next most important chapter, transfer pricing.
Transfer pricing in the elective paper is really very, very important chapter. There are many provisions like APA, secondary adjustment, Section 94B, disallowance in respect of interest to non-resident AE, this your CBC reporting. These are frequently asked question on these topics. Of course, the ALP adjustment is one of the basic concept in transfer pricing on that aspects. So these are the some things which you are can find in each attempt. Every time transfer pricing is one of the most crucial topic on which one of the case study or in other case studies some of these concepts are being tested in a way or in otherwise way. So some of the things which creates confusion like secondary adjustment, what is the interplay between this secondary adjustment or the interest disallowance which is attracted as per Section 94B? What is the linkage between these two provisions? In this session we want to clarify that aspects to you and what exactly we have to do in the secondary adjustment and Section 94B. So first let's understand what is a secondary adjustment. This secondary adjustment Section 92CE provides for when to make the secondary adjustments. First of all, when to make the secondary adjustment. Secondary adjustment has to be made by the assessee when there is a primary adjustment. Primary adjustment kya hai? What is primary adjustment? Primary adjustment is the ALP that you have not undertaken your transaction at the ALP price. Then you have to make some adjustment, right? So that the determination of transfer price in accordance with the arm length principle, right? The determination of transfer price in accordance with the arm length principle as per the arm length price method, where you have to determine your transfer your pricing which you have undertaken with the non-resident AE. And so in that case, if it is tantamount to increase your total income and reduction in your loss, that amount, the ALP adjustment, is said to be a primary adjustment. So primary adjustments may be made in certain ways. Like for example, if a primary adjustment has been made by suo motu by the assessee himself in his return of income, then you have to make a secondary adjustment. If it is made by the assessing officer and which is accepted here, right? If you have gone into some appeal or some dispute resolution you've gone into, then you need not to do the secondary adjustment. If it is being accepted by the assessee, then you have to do the secondary adjustment. Then if it is being determined by advance pricing agreement, one agreement being undertaken between you and the tax department, that the transfer in respect of certain transaction, the pricing has to be determined in according the mutual understanding of their methodology. So they have been mutually come to a place that that particular method may you have to compute the pricing of a particular transaction. So as per the agreement, if you are making some adjustment in your transfer pricing, in your pricing of the international transaction, then in that case also you have to make the secondary adjustment, and that adjustment, ALP adjustment, which you are making in accordance with the APA agreement, advance pricing agreement, that is called primary adjustment. And if you are making the primary adjustment as per APA, then you have to carry out the secondary adjustment also. If it is made as per the safe harbor rules, as of now for AY 23-24, no safe harbor rules are being prescribed right? So safe harbor rules अभी नहीं है AY 23-24 के लिए still. So old years के लिए हैं. If it is in relation to earlier years, then you have to must be having your book with you, income tax rules. So that you have to refer. Right. If it is in relation to earlier previous year or earlier assessments year, in that case, right? For AY 23-24, they have not come out with the safe harbor rules. And if it is arising as a result of a resolution, map ke according, if some resolution being come out, then in accordance with that resolution, you are making some primary adjustment. In that case, also you have to do the secondary adjustment. So in all these are the circumstances when the assessee has to make the secondary adjustment. But before that, there are two other conditions also for when the secondary adjustment need not to be made. When the amount of primary adjustment, when the amount of primary adjustment made in case of an assessee in any previous year does not exceed this 1 crore rupees, or it is in respect of AY 16-17 or earlier assessment years, then also you not to bother about the secondary adjustment. So the limit you have to remember, this is 1 crore limit. The primary adjustment is less than 1 crore, and 1 crore or less, then you need not to make the secondary adjustment. And it is in respect of earlier assessment years also, then also you not to. Suppose API you have entered into rollback provision, it is related to assessment year prior to the assessment year 16-17 and something. In that case, according to the API also you not to make the secondary adjustment. Right. So what then will happen if you are making the secondary adjustment or you have done the primary adjustment? Then they have put some that in that case now what will happen? You have to repatriate that amount from the AE, Associated Enterprises, to India, right? Then otherwise what will happen? They have given some time limit that you have to bring that amount from your AE to India. If you are not making it to India, if you are not bringing repatriating to India within that prescribed time limit, the time limit are prescribed in Rule 10CB. So if you are not prescribing, if you are not repatriating that amount within that time limit, then what will happen? That amount will be deemed to be an advance made by the assessee to such AE, and the assessee is required to pay interest on that amount. So deeming advance concept is there, right? While applying the secondary adjustment, deeming advance concept is there. That amount, the excess money which you have been, excess money, what is excess money? Excess money is the amount ALP primary actual value of the transaction or ALP primary adjustment. ALP pe apne you have determined the advance arm length price, right? And that minus actual value of transaction is your international transaction, is your excess money. If you are not able to repatriate that amount, then that would be deemed as advance, and you have to compute the interest in the prescribed manner. That manner is also being prescribed, and it is very, very important. You should know what rate to be applied. This will you will come to know when you read the facts very carefully. Like for example, interest transaction, whether it is denominated in Indian currency, whether it is denominated in foreign currency. If it is denominated in foreign currency, then what rate to apply to compute the interest? What rate means foreign exchange rate to convert that foreign exchange amount, right? So these are the aspects you have to very carefully read the facts and analyze what rate to apply for computing this interest portion amount. So interest you have to compute, that interest have to be computed, but sometimes it is possible that without analyzing the what actually you have to do, you are just solving it just applying the rates, whatever just come to your mind. Don't do this. Read the facts carefully, then come to the conclusion ki what rate and how, from which date the interest has to be computed, right? So this is a very, very important aspect, and generally you have to compute the interest day-wise basis. You have to compute the interest on per day basis. So what the other option? So it is basically being noticed that the assessee, the Indian entities are not able to repatriate that amount from the outside entities, the AE's general counsel. So for that purpose, what the government has given, they have given the option to the assessee. If in case if you are not able to repatriate your account and you have to make the secondary, don't make that amount, you have the option to pay the additional income tax on the excess money portion. If you are paying the tax, you are free. Then you need not to make any kind of secondary adjustment in your books of accounts also. Just you pay that amount to us and you are free from making any secondary adjustment. So that option is also given. In that case, what will happen if the assessee opt for paying to the government as the additional income tax, right? then in that case, whatever will be the time he is paying, there is a time limit. Beyond that time limit, you are not able to repatriate. Then interest will start charging on that amount of excess money which is deemed as advance. And from the date, suppose you have paid within that time limit itself, you have paid the interest, that additional income tax, so you not to pay any kind of interest on that amount. If it is beyond the time limit of that given to you, and then you are making the this additional income tax, then you have to compute the interest amount till the date of making the payment of such additional tax. So what is the additional tax? Tax is at the rate of 18%, then plus 12% surcharge rate, and 4% is the cess amount. So here the surcharge is not dependent on your total income. It is a flat 12% rate has to be applied on the excess money portion, right? It's a flat surcharge. You don't confuse with the key what is the total income of the assessee, then only surcharge has to be applied. No, surcharge is applicable in all the cases. So the consolidated rate is 20.9664% on the excess money you have to apply to compute this amount of additional income tax. Now let's see what are the time limits. Just quickly revise those time limits. Up from when the assessee is required to repatriate the money, or what is the time limit with the assessee for the purpose of repatriating that money, and in case if he is not repatriating that money within the prescribed time, then from which date the interest has to be computed. Rule 10CB prescribed for the time limits for repatriation of excess money and for the purpose of computing the interest chargeable on excess money which is not repatriated from a particular date. So when the primary, what are the cases when the secondary adjustment is required to be made? First is when the assessee is making the primary adjustment suo motu. Himself he is making some adjustments. Then in that case, the time limit for repatriation with him is from the due date. From the due date, not the actual date of filing return of income. It is from the due date. That is, in case of international transaction, 30th of November of the relevant assessment year, right? So from that due date till 90 days you have to compute, right? If 90 days that he is not bringing it, it's 31st of March, it's 30th or 31st of March of the relevant assessment year, it would be. Then in that case, what will happen? That amount of excess money will be deemed as your advance. And on that advance portion, you have to compute the interest amount. And that interest, when to compute? It is after the 90 days time? No, it is from the due date itself. Means for 90 days also you are required to pay the interest amount. Okay? So accordingly, you will compute the interest. That is also from the due date of filing of your return under section 139(1), that is due date 30th of November. You have to compute of the relevant assessment year the interest portion also. If primary adjustment is determined in the order of AO or the appellate authorities which has been accepted by the assessee, means he is making the primary adjustment as per in accordance with the order passed by the assessing officer or the appellate authorities. In that case, from which date the time limit will start? The date of the order. Similarly, the interest also you have to pay from the date of the said order. So 90 days period you have to count from the date of the order of the assessing officer or the appellate authority, and accordingly you have to compute the interest. If it is not repatriated within the 90 days from the date of the order, then you have to compute the interest amount from the date of the order itself, right? Third is where the primary adjustment is to be made in accordance with the advance pricing agreement determined as per the advance pricing agreement. Here the dates are quite different, so you have to very carefully note these dates. There is a difference between the date of repatriation, the time limit prescribed for the repatriation purpose, and for the computation of interest portion, right? So don't get confused with the other date, because what is happening here, the same date, from the same date you have computed the interest portion. Whereas in case of APA now, what is happening, if there are two cases, if you have entered, if the assessee has entered into the APA on or before due date of filing return of income for the relevant previous year. If you have entered before, so it means 30th of September for relevant, this is assessment year is 23-24, right? So 30th of September 23, before you have entered into APA, then the date of filing means actual dates you have to compute, not the due date here. Here it is the actual date. actual date of filing, right? But here the interest has to be computed from the due date of filing return, right? It is very important to note it carefully. So the date say you have the time for repatriation purpose, but in case you have not repatriated the amount within that prescribed time, then you have to compute the interest from the due date of filing return of income. If the APA has been entered into or after the due date of filing return of income after the 30th of November of 23 for the relevant assessment year is 23-24, then after it is being entered into, then the end of the month. Note these dates, the end of the month in which APA has entered into. जब APA entered हुआ, not the date of entered. You have to see the end of the month in which APA is entered. Similarly, for computation of interest also, the end of the month, so you will start computing the interest amount. Then in the third case, where the option is being exercised for by the assessee for the safe harbor rules, then the due date of filing return, here it's same. Due date of filing return, here also it's due date, here also due date, same thing. Then where the primary, as per MAP, you are making the primary adjustment, then the date of giving effect by the AO under Rule 44H to such resolution. The date of giving effect by the AO. When the AO is giving effect to the mutual price as per the agreement, and then from that date you have the time for repatriation, and similarly for computing the date that interest portion, the similar date. So here the main difference is in only in case of APA, where the APA is being entered before the due date of filing return of income, then there is a difference for computation of repatriation and the computation of your interest portion, right? Repatriation का time limit and the computation of interest portion, there is a difference. Otherwise, in all the cases, the same dates you have to compute the time limit for repatriation, and if not within that prescribed time limit, then you have to compute the interest from the same date, right? So remember it. Then the rate, of course, it is again very important, and this is dependent on your facts of the case study. You have to read the facts very carefully. In what denomination the international transaction is being given to you. If it is given in Indian rupees, right? If it is given in Indian rupees, then what you have to do? You have to take 1 year this SBI lending rate as on 1st April of the previous year, relevant previous year, plus this is 3.25%. Here there is a difference. Here we are adding margin this 3.25%, and here in case of internal transaction is denominated in foreign currency, you are adding 3%, and the rates are also different. Here we are taking the SBI rate, SBI lending rate as on 1st of April of the relevant previous year. Note the words relevant previous year. And in case whether it's in foreign currency, then you have to take it at 6 months LIBOR. It must be given to you in the facts of the case study. What is the LIBOR rate? And then this 3% you have to apply, right? As on 30th September you have to see, not 1st April. Okay, not 1st April. In case of file, in case of Indian rupees, it is 1st April of the relevant previous year. Whereas if the international transaction is denominated in foreign currency, then you have to take the LIBOR as on 30th September of the relevant previous year plus 3%, right? What rate you have to, in case international transaction is given to you in foreign currency, you have to compute the tax liability in Indian rupees. For that purpose, you have to compute the interest also in Indian rupees. Then if it is in foreign currency, then you will take TTBR rate. It will be given to you in your case study, but of course you have to check with the dates. What date you have to apply. Here for the purpose of conversion, you have to apply the TTBR rate of such currency on the last day. Note these words, on the last day of the previous year in which such international transaction was undertaken, right? So note these. These are the things which make your answer wrong or right. So be very careful while applying the rates. What rate you have to apply, from which date you have to compute the interest portion, and what is the time limit for repatriation, right? And the computation of additional income tax also, if the same amount is not repatriated, if the assessee has the option to pay that amount also. This is about the 92CE provision. Now we are going to 94B. What is this section 94B talks about? Section 94B, basically it is limiting the interest deduction. Actually, they are limiting the amount of interest deduction from your PGBP. So what is happening means companies or undertakings can do financing their things, businesses by way of equity or by way of debts also. In case of equities, you are not going to get any kind of deduction for paying the dividend amount. Whereas in case of you are funding your activities and all things from by raising debts, then interest amount is eligible for deduction, right? But major concern arising where you are borrowing the funds from a location outside, cross border you are raising the funds, and here you are claiming the wholesale interest as a deduction, whereas that interest amount in a low from a, raising the fund from a lower tax jurisdictions, then that amount will remain untaxed or taxed at a very lower rate. In order to curb these kinds of practices, what is happening, the OECD is coming out with action plans also. They are making the rules to prevent shifting of profits through the excessive interest payments. What they are doing, action plan 4, remember this will help you. Which action plan? Sometimes the question also asks which action plan of BAPS provides for this similar kind of provision for interest deduction limiting. So this is action plan 4, which lay down for limiting the interest portion for claiming the deduction. Action plan 4 is which recommends certain measure in with respect to this kind of interest payments. So in line with these BAPS, income tax also inserted section 94B, which limits the interest deduction which you are making payment to a non-resident AEs, right? So exactly when the provision is applicable, first of all you should know when to apply the provision before computing the interest amount, deduction amount and everything. First thing is whether the provision is applicable or not. Sometimes it's happening they have given you the whole soul data and everything, and they have given some options also, but you are going to compute also. This is the amount of interest reduction which is disallowed, but aap dekhoge here the provision itself is not applicable. So you have to very carefully note when the provision has to be applicable. What are the things? The provision is applicable to an Indian company or a PE of a foreign company in India. Okay? Being the borrower, which borrower incurring expenditure, of course they are making the payments. It's deduction. It's a restriction on the amount of deduction part, so they must be borrowing the amount, and who incurs expenditure by way of interest or similar nature. This word is similar nature is quite very difficult. Interest is okay, but fees or something you are paying in the similar form, that also will come into the interest portion amount. So in respect of any form of debt issued by a non-resident who is an AE of the borrower. See, यहाँ पे आपको लग रहा है it's very simple provision, but before applying this provision, what you have to do? You have to check whether the debt is issued by the AE or not. AE का concept you have to check, right? AE के लिए आपको provision देखना पड़ेगा whether AE provisions लग रहे AE है या नहीं है, right? Suppose direct entity is not AE, but the main controlling other entity which controls this one also and this one also, that become your AE, deemed AE. So that provision, deemed AE also will come into picture. So you have to determine whether the a lender is from where you are taking the loan is your AE or not. Or there are some deeming provision also in case if it is being guaranteed also. Suppose this is the proviso to section 94B. There it says provision of guaranteed deposit of matchmaking amount deemed to be debt मानेंगे यहाँ पे, where the debt is issued by a lender which is not a AE. वो आपकी AE नहीं है. The person who has given you a loan is not your AE. आपको पता चल गया कि ये AE नहीं है, but an AE, other AE is giving you guarantee, providing guarantee in respect to such lender on your behalf, then deposit, it giving some deposit to the lender for the corresponding or matching amount with the lender. Such debt, वो debt भी माना जाएगा that it is deemed to have been issued by the AE. ठीक है? So this is very important. From whom you are taking the loan, हो सकता है the person from whom you are taking the loan is not your AE, but the AE of yours is providing some guarantee or depositing a corresponding amount or the matching amount to your lender, right? Then such debt will also be deemed to be issued by the AE. राइट. सो आपको यहाँ पे यू हैव टू अप्लाई द प्रोविजन 94B. फर्स्ट तो कंडीशन आपने देख लिया कि इट्स बीइंग इशूड बाय द नॉन रेजिडेंट AE, और if it is not a non-resident AE, it is being non-resident AE provides some guarantee or implicit or explicit guarantee or deposited the equivalent amount to the lender. Then in that case, further, it is applicable on an Indian company or a PE of a foreign company. So you have to check whether the PE has provided you the loan. If a PE is in India that provided you a loan, then also this provision would get attracted, right? Some other exceptions are also there. What are those exceptions? When it is said कि PE case में नहीं लगेगा. In case of a, these are the important thing. Certain business they have excluded. Basically what they have done, they have excluded the business of banking or insurance. If the following has been excluded from the applicability of provision of this section: an Indian company or a PE of a company, a foreign company, which is engaged in business of banking and insurance. If the PE is engaged in the business of banking and insurance, then you need not to apply these provisions, right? Or where interest paid in respect of a debt, where you are paying the interest in respect of a debt which is issued by a lender, which is a PE in India of a non-resident. ठीक है? Being a person engaged in business of banking, suppose interest paid in respect of a debt issued by a lender which is a PE, वो आपको दे रहा है if it is engaged in business of banking. ठीक है? Some PE is engaged in business of banking from where you are raising the loan, right? In that case, you need not to apply the provisions of section 94B. So these are the exclusions which you should see while applying this, computing this interest deduction, disallowance. These are the things. Further, one more important aspect is the provision of this section would be applicable only where the expenditure by way of interest or similar nature exceeds ₹1 crore. Here also the limit, same threshold limit. वहाँ पे 92C में you have seen the, if the primary adjustment exceeds 1 crore, then only you have to make the secondary adjustment, repatriate that amount. And here also disallowance would attracted only where the interest amount or the similar amount exceeds 1 crore in respect of any form of debt issued by a non-resident being a AE. ठीक है? You have to see the amount with the respect to a non-resident AEs only. It's important that you have to see the amount with respect to non-resident AE only for computing, seeing this limit of 1 crore rupees. Then in case certain disallowances are attracted, how to compute this disallowances? Let's see how to compute this disallowance is again very important. That the excess interest, they are saying, they are terming is that excess interest, whatever be the excess interest will not be allowed as deduction while computing the PGBP. So what is this excess interest amount? How to compute that excess interest amount is again very important. How you will compute it? Total interest paid or payable. Total interest here, basically here, total interest is also the amount which you are paying to the non-resident AEs only. As this is the intent of the this act, and which is being also as per the explanatory memorandum also, they are intending only that this total interest amount is not the amount inclusive of your residents paying to the resident AEs and all. So here it is only non-resident you will consider. Of course, we given two we have computed this excess interest in the two ways, two alternatives always we are giving. But the main intent of is here it's total interest. They have used the word total interest paid or payable. It is also it is also the same which we are paying to the non-resident AE, right? So it is being given by way of guide. It's being clarified in our institute's guidance note on the tax audit. There they have also been clarified this in total interest amount or paid or payable under subsection 2 or is it similar as being used the word in case of section 94B subsection 1. So basically first alternative should be based on the non-resident AE only. In excess of total interest paid or payable in excess of 30% of its earnings before interest, tax or depreciation. These are important words. EBITDA, right? EBITDA you have to see of the borrower in the previous year, 30% of it. Total interest less 30% of EBITDA. Then that has to be compared with the interest paid or payable to the AE for that previous year. Whichever is lower you will take as excess interest. So that excess interest amount will be disallowed to you. For example, suppose EBITDA, I am giving you EBITDA is your 100 lakhs. EBITDA is your 200 lakhs. For the previous year, 21, 22, 22, 23. Okay. So EBITDA is 200 lakhs. You are paying to the non-resident AE interest. How much you are paying? Suppose you are paying interest of rupee 100 lakhs. Okay. So how will you compute? Directly you can see here it's EBITDA 30%, total interest is 100 minus 30% of your EBITDA is 60 lakhs. Okay. So here it is 40 lakhs, and how much you are paying to the AE is 100 lakhs. What is lower? Lower is 40 lakhs. Right? So this is excess interest, which is going to be disallowed. Actually, 30% of EBITDA is only allowable. So 60 lakh expenditure you will allow. Remaining 40 lakhs you are going to disallow as per section 94B. So you have to compute. Similarly कर सकते हो. If the suppose यहाँ पे EBITDA is more than 200 lakhs. Suppose it's 500 lakhs होता है EBITDA. 500 lakhs is EBITDA. Right? So यहाँ पे excess interest क्या होता है? Excess interest is nothing because you are not paying in excess of 30%. It's 100 minus 120 lakhs. So it's nil only. You are not paying anything nil. So nil is the disallowance in that case. Right? Whichever is lower is nil amount. 100 lakhs or nil. Whichever is lower is your disallowance. So disallowance is nil. Whole of the interest would be allowable to you if the EBITDA is 500 lakhs. Here the common mistake, you need to see and compute this EBITDA portion also. Suppose net profits are given after taxes or interest or depreciation, you should see it carefully what information is given to you. It's before taxes only, or after interest on depreciation but before taxes, or it's after everything. So accordingly you have to compute, because EBITDA is before net profit, before allowing you any interest, taxes or depreciation. If it is after, then you have to add back to compute the EBITDA amount. Right? It is very important. You note the information, what exact information is given to you. Right? This is the way you will compute the disallowance person. Further, the provision also provides that in case some disallowance is attracted under this section for a particular previous year, then the assessor is eligible to carry forward that excess interest portion up to what time? Up to 8 years. Up to 8 assessment years immediately succeeding the assessment year for which the disallowance was first made and claimed as deduction against the income computed under the PGBP to the extent of maximum allowable interest. This is very important terms actually. I will explain you this with the help of an example. Same example we will take here. For 2 assessment years, let's take. Previous year, abhi aapne dekha, it's 20. Let's take it for 21, 22. And previous year is 22, 23. ठीक है, यहाँ पे हम ले लेते हैं, let's take EBITDA is we have taken 200 lakhs. ठीक है, यहाँ पे हमारा तो 200 lakhs. Here the EBITDA is 400 lakhs, suppose. Right? Interest to the non-resident is, we are paying how much? We are paying 100 lakhs. Here also we are paying 100 lakhs. ठीक है? Now, disallowance कितना attract होगा? Disallowance, how much disallowances will be attracted? As we computed, it's 40 lakhs. 40 lakhs you have computed the disallowance, since 60% of EBITDA is 200 lakhs ka it is, sorry, 30% of EBITDA is 60 lakhs rupees. ठीक है, 60 lakh interest is allowable, while 40 lakhs is disallowed. So this 40 lakh amount you can carry forward to the subsequent year, right? This is the excess amount which you can carry forward till 8 assessment year, right? Here, what is the 30% of EBITDA is 120 lakh rupees, and you are paying only 100 lakh rupees. So how much deduction you will be eligible for? 100 lakhs you will be eligible this year, for this year, previous year, but this carry forward amount of rupees 40 lakhs, is it allowable in full? No, it has to be restricted to the amount which is maximum allowable to you. Here they are saying to the extent of maximum allowable interest expenditure. यहाँ पे maximum, what is the limit of maximum interest is 30% of EBITDA is the maximum limit. So 120 lakhs interest only will be allowable. So here 100 lakhs for the relevant previous year and 20 lakhs for the excess interest which you are carrying forward from the previous year 21-22. So it's 120 lakhs only you will be allowable during this previous year. So this computation is also again very important, right? So here you have to rest it. So if the question, in that case, they will give you the information relating to 2 previous years, suppose, and they are giving or some carry forward amount they have given you, then you have to compute the amount of interest which is allowable during the previous year 22-23 by applying this provision. At excess amount you have to allowable only to the extent of maximum allowable, that is 30% of EBITDA only you are allowing, right? So this is the sum. This is the very important provision which you should remember ki how much interest you can allowable from the carry forward amount this year. For that purpose also it has to be restricted to 30% of EBITDA. I hope this concept is clear to you. Now this is the summary of this thing, whole of the 94B. Let's just give a quick glance to it again. Is the borrower, if the borrower is an Indian company or a PE of a foreign company, if it is so, then only the 94B attracts, right? If it is yes, no, 94B would not apply. If it is a borrower, if the borrower a bank or insurance company hai, then also the provisions are not attracted. Yes, then not attracted. Is the lender a PE? अगर PE है इंडिया का of a resident engaged in business of banking, then also 94B would not be attracted. Then again you will see, so these are the conditions you are going to see before applying this 94B. Borrower कौन है? Who is the borrower? Right? First these 3 things. Then you will see interest payment का amount कितना है? How much is the interest pay amount to the non-resident A? It exceeds 1 crore rupees. If it is exceeds 1 crore rupees, then excess interest not allowable as deduction, right? And disallowed interest can be carried forward for 8 assessment year for deduction. So disallowance जो भी है, which you can be carried forward for 8 assessment years for deduction against PGBP to the extent of maximum allowable interest expenses. So you have to compute. This is the manner of computation, that total interest paid or payable. This is generally we are going to take is as non-resident AEs only in excess of 30% of EBITDA or interest paid or payable to AE for that previous year, whichever is lower. Now, what is the interlink between these 2 sections, 92C and 94B? Mainly, you have to see the link between two sections only in respect of interest transaction. Since 94B disallowance also is attracted in respect of interest transaction, if you are making some ALP adjustments, means primary adjustment in respect of interest transaction, then you will see 92CE or 94B कौन सा पहले आएगा, which has to be applied first. This is the main concern basically here, कि दोनों में डिसअलाउंस अट्रैक्ट हो रहा है आपका. 92CA में भी डिसअलाउंस होता है, ALP एडजस्टमेंट करनी पड़ती है, यू हैव टू ऐड ऑन इन योर total income. Here also you have to restrict your deduction to 30% of EBITDA as per the 94B. So which has to apply first? Let's understand with the help of this MCQ. This MCQ provides you EBITDA of ABC Limited, an Indian company, for 10 crores. It's being given, right? It paid interest of 5.20 crore to PQR UK, which is a specified foreign company. AE है यहाँ पे in relation to ABC Limited. The arm length price using cup method. Cup method के according you have determined that this interest has to be restricted to 4.15 crore. That means you have to make some primary adjustment in your books of accounts. And it is being made suo moto by the assessee himself. Made the transfer pricing as while computing its total income. It already restricted. On the basis of the above facts, examine the correctness of the following statements, assuming that no other interest is payable by ABC Limited. See, if the adjustment is made by this primary adjustment is made suo moto by the assessee, then he should do restrict that transaction as per ALP. He should compute the value of that transaction by applying the arm length principles. That means he has to apply the 92CE provision first. Primary adjustment he has to make first. Then he has to do the 94B. Right? What is happening? आर्म लेंथ पे अगर आपने कंप्यूट कर लिया 92CE में, ऑलरेडी आपने रिस्ट्रिक्ट कर लिया, then it has to be further seen कि 30% से excess नहीं होना चाहिए. It should not exceed 30% of your EBITDA value. 94B. So here the EBITDA is 10 crores. It's 10 crores. आपका कितना आएगा? How much is allowable? 3 crore is allowable to you. If you have already restricted to 4.5, 15 crore से आपने कर ही लिया ALP adjustment, you have already made to your books of accounts. So how much is disallowed in section 94B? आपका कितना होगा अलाउ? 94B में आपका क्या होगा? 4.15 minus 3, right? So 1.15 करोड़ का आपका डिसअलाउंस कहाँ पे अट्रैक्ट होगा? 94B में. ठीक है, यहाँ पे प्राइमरी एडजस्टमेंट कितना का? हाउ मच यू हैव टू मेक? 5.20 माइनस 4.15. सो 1.05 का यू हैव टू मेक प्राइमरी एडजस्टमेंट, राइट? प्राइमरी एडजस्टमेंट कर रहे हैं, दैट अमाउंट यू हैव टू रिपैट्रिएट सिंस इट exceeds your 1 crore limit also, and it is respect of assessment year 23-24. You have to make the secondary adjustment. So 1.05 is the primary adjustment amount, and 1.15 crore is the disallowance which will be attracted as per section 94B. So what the options they are being given here, they are saying arm length adjustment as per 92C would be, it's 92 see arm length adjustment कितनी हो रही है? 105 crore की. The excess interest under section 94B would be 1.15 crore. So secondary adjustment in respect of secondary adjustment आपको total करना पड़ेगा. You have to make the secondary adjustment total. No, secondary adjustment क्या है? Secondary adjustment is the basically आपको primary adjustment कितनी करनी पड़ती है? How much primary adjustment you have to make up to the restricted to the ALP amount. ALP आपका इतना था, but further restriction they put by way of 30% EBITDA by way of 94B. So this is not a secondary adjustment. Secondary adjustment is only up to the ALP limit, right? So secondary adjustment, primary adjustment is only up to the ALP limit only. So primary adjustment यहाँ पे कितनी की करनी पड़ेगी आपको? Only 1.05 की, not wholesale amount. It is not 5.20 minus 3. EBITDA तक नहीं कंपेयर करना, आपको ALP से कंपेयर करना है इसको. You have to compare it with not EBITDA value 30% EBITDA, you have to compare it with the ALP. So it is 4.15 से कंपेयर करना है, ठीक है? 2.20 नहीं करना है. This is wrong. ठीक है? So the excess, then the second option given to you is excess interest under section 94 would be no 94B का आपका सिर्फ 30% देखना है, वो भी that to compare. Already you have disallowed as per the ALP adjustment you have already made. So 94B you have to restrict to the from ALP to 30%, from ALP price to 30%, right? It's also wrong option. Then C, they are giving excess interest under section 94B would be 2.2 crore and secondary adjustment 93 is required to be made in respect to the said amount. No, it's not same. यहाँ पे और यहाँ पे it's not same. The option giving you that arm length adjustment as per section 92C would be one primary adjustment कितने की होगी? 1.05 crore की. The excess interest under section 94B would be 1.15 crore. 94B में 1.15. Secondary adjustment is required to be made in respect of similarly 1.05 की primary थी, उसी के respect में you are going to make the secondary adjustment for 1.05 crore. If such sum is not repatriated within 90 days from the due date, then you have to make the secondary adjustment. So primary adjustment आपको कितने की करनी है? 1.05 की and 1.15 की आपकी 94B adjustment. Right? It is suo motu. If the assessee is doing the adjustment suo motu, he himself is determining the value of the transaction by applying the arm length principle. Then he will first make the adjustment as per the primary adjustment. Then he will do and compute the disallowance under section 94B. But suppose if he is not making himself the primary adjustment, if the primary adjustment is made by way of order of assessing officer, what will happen then? In that case, what will assessing officer will do? Basically, it looks ki if he is making the himself, then in that case, suppose AO ने determine किया है यहाँ पे आपका, AO is determining himself, he is not determining. He has considered, he has claimed the deduction of rupees 5.20 crores, but restricted to 94B से उसने restrict किया 30% of EBITDA. So 5.20 को उसने 3 crore only he claimed as deduction. Remaining what he will do? He will carry forward this amount. He will do carry forward of this amount. 2.20 का carry forward करेंगे. But ALP उसने determine, AO has determined the ALP amount suppose of 4.15 का. So what will AO going to do? He has already not claimed in his total income the whole of the interest amount. What he is going to do? Then he is himself going to do the reduce the amount of carry forward. वो क्या करेगा? AO is going to reduce the amount of carry forward by the amount of this primary adjustment. So 1.05 से आपका वो reduce कर देगा. He is going to allow you only carry forward कितने का करेगा? 1.15 करोड़ का ही only allow करेगा carry forward करना. क्योंकि ऑलरेडी आपने क्लेम नहीं किया. यू हैव नॉट क्लेम्ड इन योर रिटर्न ऑफ इनकम. यू हैव क्लेम्ड ओनली 3 करोड़ का इंटरेस्ट, राइट? सो 1.15 का एक्सेस इंटरेस्ट यू आर कैरिंग फॉरवर्ड, दैट ही इज गोइंग टू reduce it. See, so this is the way we have to apply these provisions 94(2)(CE and 94(B). Another interesting MCQ here is let's see what the difference between these two MCQs. Here the EBITDA of Ganga Limited, an Indian company, for the financial year 22-23 is given as 800 lakhs. Right? It paid interest of 440 lakhs to Ence Inc. Brazil, which is a specified foreign company. It's a AE only. The arm length price is computed as per applying the cup method for 350 lakhs, and Ganga Limited suo made the transfer pricing adjustment while computing its total income. Now you have to determine. Let's compute both the things. आपको पता चल गया cup method पे आपके ALP you have determined is 350 lakhs only, and so here let's compute this disallowance. 800 lakhs के EBITDA कितना? 800 lakhs का हुआ. 30% of EBITDA is coming to 240 lakhs. ठीक है. यहाँ पे what amount है the company is claiming as reduction? 350 lakhs का only it's claiming. So 350 को आपको कितने से restrict करोगे? 240 से. 110 की disallowance attract होगी as per section 94B. ठीक है. 94B की 110 lakhs की disallowance attract होगी. यहाँ पे primary adjustment कितने की कर रहे हैं? How much primary adjustment he is making? Ganga Limited, it's a 440 minus 350. कितना हुआ? 90 lakhs का only. Do they require to make secondary adjustment? No. Since primary adjustment is not exceeding 1 crore rupees, they are not going to do the secondary adjustment. Primary adjustment तो करी है उन्होंने, but secondary adjustment की जरूरी नहीं है. So they have reduced their total income by this 90 lakh rupees. They are not claiming it as, but इसलिए यहाँ पे it has to be restricted. यहाँ पे even though they are not supposed to make or repatriate the amount, this primary excess money amount, but this 94B की restriction जो होगी, the 94B की disallowance होगी, that has to be to the extent of ALP. ALP को compare करना है आपको EBITDA के 30% से, not with 440 lakhs. आपका secondary adjustment is something which you have to do when you are going to do primary adjustment, when you are not repatriating the amount. But if you have not required to do secondary adjustment, but still you have to make the primary adjustment, right? So you have to increase your total income by this 90 lakh rupees. ठीक है. So here what would be the correct answer? D is the I am directly going to the D option. The excess interest under section 94B would be 110 lakhs. 94B का आपका 110 ही होगा. It would not be it's not going to be your 200 lakhs. 200 नहीं होगा because 90 lakhs की आपकी primary adjustment है. Already reduce the interest reduction amount, and then it has to be further reduced to 94B by applying the provision 94B. So accordingly 110 lakh की और 94B excess interest disallowance होगा, and secondary adjustment there is no requirements. It is not exceeding 1 crore rupees. Here this is specified foreign company. Basically this specified foreign companies is relevant with respect to section 115 BBD also. There they are saying if an Indian company is receiving some interest from a specified foreign company, it would be chargeable to a lower concessional rate of 15%. So but by the Finance Act 22 students, it's very important amendment for you. They have abolished this. They are not withdrawn. They have this section is not relevant from AY 23-24. So that portion amount, whatever you are repatriating, whatever amount you are getting from the specified foreign company, also it would be chargeable to tax in the hands of as per the normal rates, not at the rate of 15%. Right? So this being amended this year only, they have withdrawn this section this year. So the concessional rate of 15% is now no more relevant for you. That when section 115 BBD is not relevant for you from this May 23 attempt. So this is about this section 92 CE and 94B, and of course, I hope that these sections, the main crucial points which we are telling you are very helpful for you for your exam preparation. Now we can take you through some further important aspects which we feel are really very important, means being tested very frequently. Basically, these provisions, force of attraction rules.
The force of attraction rule is a concept which has been often tested. It is not a concept which is there in the Act, but it is there in the model conventions, and it is there in some of the DTAs which India has entered into. What is exactly force of? For that, we have to understand the taxability of business profits. So, as you said, for everything, the scope of income is very important. For a resident, the global income is taxable. For a non-resident, only income earned in India, accrued, arising in India, received in India, deemed to be received in India, deemed to accrue, arise in India is taxable. Now, business profits of an enterprise located abroad, when would it become taxable in India? Or for that matter, any this thing, in case it has a PE, India has a PE with that, India has a DTA with that particular country, say country A, it has a DTA, then business profits will become taxable in India only if country A does business in India through a permanent establishment situated therein. See, as per the Income Tax Act, it is brought to tax by virtue of business connection in India. It uses the word in 911, income from a business connection is deemed to accrue, arise in India. There, the concept of business connection is discussed, carrying on business activities through a person in India. That is where, as per the Income Tax Act. But when the DTA applies, we have to look into the concept of permanent establishment. So, business profits, and this permanent establishment is relevant only in the context of profits and gains of business or profession. Only for that purpose, the permanent establishment is relevant. So what does the Model Tax Convention says? Article provides for a situation. Article 7 is on business profits. Okay? Provides for a situation when the business profits of a non-resident would be taxable in the source state, and also lays down the criteria and extent of reduction of expenses. Okay, business profits will be taxable only when the non-resident has a PE, permanent establishment, as per Article 5 in the source state. Okay, let's go through what does OECD Model Convention say, what does UN Model Convention say, and what is the difference between the two. Okay, OECD says the profit of an enterprise of a contracting state. Okay, let us say the contracting state is country A. Okay, will be taxable only in that state. That is, it will be taxable only in country A, unless the enterprise carries on business in the other contracting state. Let's say the other contracting state is India, through a permanent establishment situated therein. Okay, so a country in a company in country A, let us say Andis Inc. It will be taxable only in country A unless Andis Inc. carries business and earns profits by carrying on business in India through a permanent establishment situated in India. If the enterprise carries on the business as aforesaid, that is through the PE, profits that are attributable to the PE will maybe taxed in that other state in accordance with the provisions of 2. That paragraph 2 gives how you go about taxing it. Okay. Now, for this, we have to understand what is a permanent establishment. When do you say that the enterprise has a permanent establishment in India? Permanent establishment is basically a fixed place of business through which the business activities are carried on. Fixed place of business. What can it be? It can be a branch. It can be an office. It can be a place of management. It can be a factory. It can be a workshop. It can be a mine. These are specific things which have been included in Article 5. To state that these are PE includes all these things, some specific instances which are clearly visible. Branch, office, factory, workshop, mine. These are the things which have been specifically, or a place of management. Okay, as far as OECD is concerned, then a building or construction project, if it lasts for a particular period of time, there they have put a particular period of time. These all constitute permanent establishment. These are some of the examples. And only if there is a permanent establishment, the profits attributable to that permanent establishment alone will be chargeable to tax. If suppose it's attributable to the permanent establishment, only to that extent it will be charged to tax in India. That is in the source state. Now, what is the resident state in this year? Contracting the enterprise of a contracting state. That is, country A is the place of residence. India is the source country. So, in the source country, to what extent there is a restriction? To the extent to which the profits can be attributable to the PE in India, to the branch in India. Suppose you have a branch in New Delhi. The profits which have been of the country A company has a branch in New Delhi, to the extent of the profits attributable to the permanent establishment will be taxable in India. What does the UN Model Convention says? It also says, initially it also says the same thing. The profits of an enterprise of a contracting state, that is country A, shall be taxable. Here let's take UN Model A. Country A has in line with OECD Model Convention. Here country B. Country B has a model tax convention in line with UN Model Convention. Okay, shall be taxable only in that state unless the enterprise carries on business in the other contracting state, that is India, through a permanent establishment situated there. Until this point of time, both OECD and UN are the same. Then, how much will be taxable for that purpose? If the enterprise carries on business as aforesaid, the profits of the enterprise may be taxed in the other state, India, but only so much of them as is attributable to that PE. Till that extent, OECD and UN are on the same lines, but thereafter, sales in the other state of goods and merchandise of the same or similar kind as sold through the permanent establishment. Business activities carried on in the other state of the same and similar kind as those affected through the permanent establishment. Okay. Now, you can see that it's not restricted only to the PE. One more thing which you have to note the difference, it's in Article 5 between OECD and UN Model Convention is, in UN Model Convention, there's a concept of service PE. That is where employees of the enterprise are sent to India for rendering services. Then, if they stay in India for more than 183 days in a period of fiscal year, then that will also be treated as a permanent establishment. This concept of service PE is, however, not there in OECD Model Convention. This is another important difference, and these differences are very important. It's all explained in the study material. You have to go through that because, then in the question they simply give in India has a DTA with that particular country which is in line with OECD or which is in line with UN, and that will make us whole difference, if it's in OECD or if it's in UN, especially in this case, if you say force of attraction rule. Okay, so here under UN, it's not only what I'm selling through the PE, but if the same or similar kind of goods I'm selling directly to the customer itself without going through the PE, even that will be subject to tax in India. As per the UN Model Convention. If the DTA is as per the OECD Model Convention, that part, what the company is selling directly to the customers in India will not be brought to tax. But if it's in accordance with the UN Model Convention, and if it's similar goods, same or similar goods, that again is important. If it's same or similar goods are sold directly to the bulk customers, then that will also be subject to tax in India. But however, if it is different goods, through the branch I'm selling one particular kind of goods, I'm selling cosmetic product. Directly I'm selling a goods of a totally different nature. I'm selling, say, some cereals or something like that. Then that force of attraction rule will not apply. It is goods which are sold of the same or similar kind as sold through the permanent establishment. And other business activities in that state of the same or similar kind as those affected through the permanent establishment. Okay. Now, and one more thing what you have to understand is this force of attraction, it applies only for business profits. If you're talking about royalty or fee for technical services, then this requirement of permanent establishment is not there because they are governed by different articles. They are not governed by business Article 7. Or capital gains or royalties, dividend and all, they have their separate articles. This is only in respect of business profits. Okay. Now, let us go to a question. Okay. We have a question through which we can understand this more clearly. Epsilon Limited, a country Z company, and Sigma Limited, a country L Limited, country L company are engaged in manufacturing of spices. Okay. Epsilon, a country Z company, and Sigma, a country engaged in manufacturing. Both of them have branches in India. Okay, both this Epsilon from country Z and Z. Epsilon Limited effects sales of spices to Indian customers P and Q through its branch, and to bulk customers M and N in India directly. So through P and Q, it does through its branch. Branch is what? It's a permanent establishment. Both have branches in India, both have PE in India. Okay, so, and they effect sale of spices to Indian customers through its branch and through other customers directly. Sigma Limited effects sale of spices through its branch to the Indian customers J and K and to bulk customers M and N in India directly. So bulk customers also it does, and through its branch also. Both companies do through their branch also, and same or similar kind of goods it does directly to customers. Examine the taxability of profits earned by Epsilon Limited and Sigma Limited from sale of spices to customers through its branch in India, and profit from sale of customers directly, considering India's DTA with country Z is in line with OECD Model Convention, and with country L is in line with UN Model Convention. So we can see now there are two countries, country Z and country L. Epsilon Limited is located in country Z, Sigma Limited is located in country L. Both of them are engaged in manufacture of spices. They both have a branch in India. They carry on business through the branch in India. In addition, they also sell goods, similar goods, spices, to customers directly. Okay. Now, country Z, India country Z DTA is in line with OECD Model Convention. India country L DTA is in line with UN Model Convention. So now they are asking you to examine the taxability of profits earned by Epsilon Limited and Sigma Limited from sale of spices to customers through branch and directly. Now you know what? India country Z is OECD. Country Z is at OECD. Country Z, Epsilon. Okay. And country L के साथ it's UN Model Convention. So in OECD, as we know, only profits earned through the attributable to the permanent establishment can be taxable. See, only profits that are attributable. This first column is the OECD. Only profits that are attributable to the PE, it's taxable under the OECD Model Convention. So whatever Epsilon sells through its branch in India, the profits attributable to that branch, that will be taxable in India. But what it sells directly to the customers, bulk customers, that is not taxable, because as OECD Model Convention does not incorporate the force of attraction rule. So with India, with country Z, it has a model convention in line with OECD Model Convention. So only profits which are attributable to the branch in India, that will be taxable in case of Epsilon Limited. Whereas Sigma Limited is a country L company, and India's DTA with country L is in line with the UN Model Convention, which incorporates the force of attraction rule. Since the Sigma Limited sells spices through its branch in India and also sells the same spices only, it is not selling some other product, it's selling spices only through bulk customers directly, then it's the sale of goods or merchandise of the same or similar kind as sold through the permanent establishment. So even though it's selling directly, it's selling similar goods. So profits earned through its branch as well as sale of the spices directly to its bulk customers, both will become taxable in the hands of Sigma Limited, because India has a DTA with country L in line with UN Model Convention. So that is the answer. So for country Z, only the profits earned through effect sale of spices to Indian customers P and Q through its branch, only this will be taxable. M and N, whatever profits it's earned from direct sale to M and N in India won't be taxable, because Epsilon, India's DTA with Epsilon Limited is, India's DTA with country Z is in line with OECD Model Convention, and Epsilon Limited is a company which is situated in country Z. On the other hand, Sigma Limited is situated in Country L, India's DTA with country L is in line with UN model. It incorporates the force of attraction rule, and similar products are sold to directly to customers. So profits from those also will be chargeable to tax in the hands of Sigma Limited. Hope this is clear. There is one more question, but that is also on the same lines. We have many more to cover, so I won't take it up. That is also on the same lines. Incorporating the force of attraction rule. Only thing which you have to remember in this case, suppose the products are different. What is sold directly to customers is not spices, but it's something else. It's sugar is sold directly to the customers. Then in that case, force of attraction rule can't be applied even if the DTA is in line with UN Model Convention. Now we go to tax on royalty or fee for technical services. This is very, very important. Royalty or fee for technical services is a very important topic. It is covered under non-resident taxation, and please pay very careful attention.
Generally, most frequently we have seen that question one or the other question are being asked based on this royalty and taxability of royalty and FTS. So these are really very, very important topics, and it involves integration of many provisions of the Income Tax Act, like Section 1, very important for a taxability of determining the taxability of a non-resident. Of course, Section 9 is very relevant for you. Right. So here for royalty also, for determining whether the royalty is taxable in India, before going into the rates, what rate it would be taxable, under what section, which provision of the Income Tax Act are applicable on it, and what model tax convention tax treaty. Of course, if it is not taxable as per the Income Tax Act, then it is more beneficial, then it would not be taxable in the hands of the non-resident, irrespective of the fact that DTA provides for its taxability, right? So Section 9 is very, very important. It's Section 9(1)(6) with respect to royalty, or 7 with respect to FTS. बहुत अच्छे से पढ़ना है, एक वर्ड को बहुत अच्छे से पढ़ना है. Many times we read, but every time whenever they ask the question for determining the taxability, we again go and see what are the wordings of this section. So very relevant section for you. For the purpose of, before going into the TDS deduction, Section 195 provides for deducting TDS in respect of payments made to a non-resident, right? But for that purpose also, it says ki thus TDS is required to be deducted on the sums which are chargeable to tax in the hands of a non-resident. For that purpose, before going into the rates into force, determining the what rate the TDS is need to be deducted, we have to come first again to see the Section 9, whether it is deemed to accrue arise in India in its hand or not. Right? Scope of total income you have to determine. So for that purpose, Section 9 again you will come and check whether it is chargeable to tax in his hands or not before applying the provision of Section 195. So Section 9 is very relevant. Section 9. Then what are the sections in case of TDS? Of course, Section 195 along with the rates in force. Rates in force means here the tax has to be deducted by the rates given by the rates in force. What is this rates in force? Given the tax rates which are given in your schedule. This is first schedule of your Finance Act, right? So here there are three parts where the rates are beginning. First schedule of the Finance Act you have to see. In the Finance Act, every year Finance Act contains first schedule. There three parts are there. So part 2 is relating to the DDS provisions. Part 3 for the deduction of advance tax in respect of salaries, and part 1 is big. Part 3 become the part 1 of many of the Finance Act of the under the previous year. So part 2 basically is relevant for you for determining this Section 195 rates in force basically. Then Section 115A, again very important. At what rate it is chargeable to tax. Specific rates are given in Section 115A. Normal rates are other. Section 115A specifically provides for different rates of tax in respect to different types of income. For example, dividend tax, interest, if it is in respect to which is referred in Section 194, LC, LD and all, royalty, FTS. Many rates are given in Section 115A. along with the certain that nothing is allowable as deduction from those income which are chargeable to tax under section 115A. Further, it is also giving a benefit कि these person are also not required to file return of income if their total income consists of the incomes which are given in section 115A. So again, it is very important, section 115A, right? Then tax treaty again. Tax treaties. If DTA is not given to you, then you will come to see the Model Tax Convention. Model Tax Convention, right? So these are the things along with section 115A for FTS and this royalty, section 44DA is also very important. So what you have to, before determining the taxability, these sections should come into your mind. Section 9, 1, 6 and 7, section 195 in case TDS provisions question relates to TDS, section 115A, section 44DA, comparing it with the tax treaties or the Model Tax Convention as the case may be. So first let's understand what is the section 916 basically. Section 916 says that royalty will be deemed to accrue arise in India when it is payable by the government. When government is paying something to a non-resident, then in the form of a royalty, then it is always deemed to accrue arise in India, in the hands of that non-resident. Then a person who is a resident in India, if a person who is a resident in India is paying royalty to a non-resident, it would be deemed to accrue arise in India. But again here, if that transfer of right or use of any property or information, or it is paid for the purpose of utilizing the services for the purpose of business or profession carried on by such person, means such resident outside India, or for the purpose of making or earning any income from any sales outside India. So in that case, it would not be deemed to accrue or arise in India. Suppose an Indian company borrowed some, taking some services and paying royalty to a non-resident entity, but that services, the technology, whatever they are using it is for the purpose of carrying out business or profession outside India or for earning certain income outside India. That case, that income would not be deemed to accrue or arise in India. That royalty would not be deemed to accrue or arise in India. Then if it is payable by a non-resident, if the royalty is payable by a non-resident to a non-resident itself, here the first question तो लगता है कि यार non-resident को pay कर रहा है, यहाँ पे क्यों tax होगा? First question is, but it is taxable. In what circumstances it is taxable? It is deemed to accrue arise in the case where such royalty or property is used or services are utilized for the purpose of business or profession carried out by such person, such non-resident in India. अगर वो इंडिया में यूज कर रहा है, ठीक है, फॉर द पर्पस ऑफ बिजनेस और फॉर द पर्पस ऑफ मेकिंग और अर्निंग एनी इनकम फ्रॉम एनी सोर्स इन इंडिया, then in that case it would be deemed to accrue arise in India. So very clear, government every time, resident के केस में every time except if for the purpose of business or profession carried outside India. In case of non-resident also, अगर ये बाहर के लिए यूज कर रहा है then it would not be deemed. इंडिया के लिए if it is using, if the business or profession is carried on by such person is in India or for making earning any income from any source in India, then in that case such royalty would be deemed to accrue arise over in India. Similarly FTS के लिए भी same provision लगते हैं, same wordings are there in case of FTS also in the similar lines, these provisions. So अब now second thing, beyond ki when it is deemed to accrue, what constitutes the amount of royalty? The meaning of royalty again at this international taxation paper is very, very important. You should understand the words, what words are being used in the act and what wordings are there in the your model tax treaties. So the meaning itself is very important for describing some payments as a royalty. For that purpose, exactly you should just, we are just running through what are these, you should read and through the act itself, you should read the Income Tax Act for understanding what is the meaning of royalty there, right? And then compare it with the treaty. All the study material also you may refer. So these are the things where the lump sum royalty not, कहाँ पे नहीं आपको not deemed मानी जाएगी, accrue arise in India, where the royalty is paid in lump sum form for the purpose of transferring all or any rights, including granting of license in respect of computer software supplied by a non-resident manufacturer, along with किसके साथ दे रहे हैं यहाँ पे, computer hardware के साथ it is embedded. That computer software they have to give along with a computer hardware, or that also under a scheme approved by the government. This wording is very important. In case of royalty also, if the contract or agreement is approved by the government, then the concession rate of 10% is applicable under section 115A. So these wordings again are very important for determining the rate of tax at which the royalty are taxable in the hands of a non-resident. So here they are saying that in case of computer software, you are giving along with the computer hardware, and under a scheme of which is approved by the government under a policy on computer software export or software development training shall not be deemed to accrualize in India. ठीक है, computer software का meaning is given. Then what do you mean by computer software? Here the meaning of royalty is given. I am not going into explaining this meaning of royalty here. The important thing which I want to explain to you is with respect to a Supreme Court ruling. Actually, the Supreme Court, in case of very important ruling, this is very important ruling for you, that Supreme Court in case of Engineering Analysis Center of Excellence Private Limited have decided that in case of royalty, there the royalty is becoming taxable as per the Income Tax Act by virtue of explanation 4 to section this 916, or read along with this explanation 2. Explanation 2 and section this explanation 4. By virtue of Income Tax Act, it is becoming taxable in India. But by the wordings of royalty within the meaning of the definition of royalty given in Singapore Treaty, the same is not taxable. So since the Income Tax Act is not beneficial to the assessee, the Supreme Court has decided that amount of royalty is not chargeable to tax in India. So exactly, let's understand what this explanation 4 act they are saying. This is very important. You read the words here. This explanation says the consideration for use or right to use computer software is royalty. By clarifying the transfer of all or any rights in respect of any right, property, information includes and has always included transfer of all or any right of for use or right to use computer software. Here they are saying कि आपने कंप्यूटर दिया, उसका right दिया use करने के लिए, it will also tend amount to royalty. Whereas in case of this, what we are saying, in case of treaties, they are saying royalty means payment of any kind received as a consideration for use of or right to use any copyright. They are saying अगर आप copyright भी देते हो use करने के लिए, then only it will be amount to royalty. But here the explanation के definition आप देखोगे, it is very vast definition. It is taking into this ambit the right to use of computer software also will amount to royalty. So whatever you are paying for the use of this computer software as per the income tax, it would be amount to royalty. But in case of, as per the treaties, most of the treaties, measure of the treaties, it is being given in the same form. The same identical definition is given in the treaties. That is, royalty means any payment, means payment of any kind received as consideration for use of or right to use any copyright. Read this word, of a literary, artistic or scientific work. So here they are not using any computer software, nothing. They are using literary, artistic or scientific work के लिए you are giving some copyright. Then that amount, that consideration amount would be considered as royalty. But here it's a vast definition. Accordingly, due to this, the usage of these words here, the same definition is being taken under section 194J also. And the same definition they have considered for the purpose of section 195 also. So in that case, the provisions of TDS also gets attracted. In case there is no DTA between a country and India, in that case, of course, the provision of Income Tax Act only have to be seen. So for the purpose of, if you are giving the right to use any computer software, and for that purpose you are making certain payments that amount to royalty, in that case section 195 provisions would get attracted. It becomes chargeable to tax in India, right? And 194J also would get attracted. But here this is one of the very important notification where section 194J would not be applicable. What are the cases? They laid out certain cases where the computer the payment in respect of uses of computer software on which the section 194J would not be applicable. What are these cases? Would not be applicable. What are these cases? Very important. If the software is acquired in a subsequent transfer, means you have already once been reacquired from the other person, and in the first, when the software was first acquired, at that time TDS has either been deducted as 194J or 195 on payment for any previous transfer of computer software, or transferee ने obtain किया, he has to obtain a declaration from the transfer, that tax already been deducted along with the pen of the transfer. So in those circumstances subsequent resale में नहीं होगा, resale हो रही है आपकी computer software की, in that case it need not be TDS need not to be deducted under section 194J. J के reference में this notification is with respect to section 194J. यहाँ पे we will again see कि some other grounds also the Supreme Court is saying, the apex court is saying that in the 4 categories of cases, the provisions of it would not amount to use of or right to use any copyright. In these cases na, that we cannot say that you are using or right to use any copyright would arise. What are these cases? In these cases basically यहाँ पे Supreme Court gone into all these circumstances only due to the meaning. They are words defining the term royalty as per the treaties, because they are using the use of or right to use any copyright. If it is so, then of course it would be chargeable to tax as per treaty also. So in these 4 categories, these are very important categories. They are saying in these categories, whatever be the amount you are paying, it would not, if you are paying something, then it would not amount to use of or right to use any copyright. What are these cases? Where a resident Indian company, basically sale or purchase cases, they are defined basically. What is this? First is where computer software is purchased directly by an end user. I am an end user. I am purchased some computer software. I am from a foreign non-resident. Then you need not to pay because I am using it. I don't have any right or use of right for copyright. I don't have any copyright here rights, but I am using it for my purpose. Then it would not be said to be that you are right to use any copyright. You don't have any right to use any copyright. Then where a resident Indian company is acting as a distributor, I am a distributor, I am reselling to other consumers and users and purchasing the software from a non-resident suppliers. In that case, it would not be attracted. Then where a distributor happens to be a foreign or non-resident vendor who after purchasing software reselling it to the Indian residents. In that case, where computer software is affixed onto hardware, it's a mandatory portion. You are transferring a hardware has no use without a computer software. So the computer software is embedded into the hardware. Then in that case also it would not be tantamount to this verdicts that amount to use or right to use any copyright. Copyright word they are using, but in the explanation they are using right to use any. You have the right to use computer software. It's a vast definition. It's a vast coverage actually. So they want to cover everything, but here they want to cover only the copyright case where you have the copyrights, then only it would amount to royalty. So in these 4 circumstances, it is out of the purview of royalty definition. In all the above cases, apex court held that amount paid by a resident Indian end users or distributor to non-resident computer manufacturer or suppliers as consideration for resale or use of computer software through end user license agreements is not royalty for the use of copyright in computer software. So this is very important ruling. In that case, again you have to say it is not chargeable to tax at all. So there is no question what rate TDS has to be deducted. Answer is straightforward. Suppose there is no DTA. If the question is specifically asking you to determine the taxability of royalty as per the provisions of Income Tax Act, then you will see and apply the explanation, right? And see these cases whether it is not falling within these cases. और आपको देखना होगा. और अगर it is not under an agreement which is approved by central government, then what rate you will apply? You will apply rate of 40% plus surcharge is applicable and cess also, right? Accordingly 195 ka TDS has to be attracted. See, read the question carefully. What is the requirement as per the income? If it is silent, then you have to compare both. If the question is silent to determine the taxability, then you have to compare the both. Extracts are given for the DTA, then you should go and see the DTA extract comparing it with the provisions of the Income Tax Act. So this is about the royalty. These are further things. FTS are also on the similar lines basically for the royalty, but of course the meaning of FTS is different from royalty, right? So the here meaning again is very important. To describe some consideration as FTS or not, you again have to check and see the meaning which is given in the Income Tax Act. and comparing it with the treaty. So whichever is beneficial, you will take the benefit and accordingly make it taxable. So this is about FTS. This is again important, very, very, very important, I must say. Explanation to section 9. It is saying if income by way of interest, royalty or FTS के respect में है, which is deemed to accrue or arise in India by virtue of clause 5 with respect to interest, by virtue of clause 6 or 7 of section 9(1) shall be included in the total income of non-resident में include करेंगे every time whether or not that non-resident has a resident or place of business in India. यहाँ पे उसका कोई business है या नहीं है, PE है या नहीं है, या उसने he has whether he has rendered service in India or not, किया हो या ना किया हो, तब भी आपका इनकम यहाँ पे डीम टू अक्रू अराइज होगा. दैट मीन्स अगर कोई रेजिडेंट कोई सर्विसेज यूटिलाइज कर रहा है इंडिया में, ठीक है, इस सर्विसेज आर यूटिलाइज्ड इन इंडिया, वेदर दैट पर्सन इज कमिंग इन इंडिया और नॉट फॉर रेंडरिंग दिस सर्विसेज, वेदर इट हैज अ प्लेस ऑफ बिजनेस और नॉट, इफ इट इज यूटिलाइज्ड इन इंडिया दैट वुड टेंड अमाउंट टू डीम टू अक्रू अराइज इन इंडिया, राइट. सो इन इफेक्ट क्या हुआ, सेम थिंग. Such interest, royalty or fees from services utilized in India would be deemed to accrue arise in India in case of a non-resident and be included in the total whether or not such services are rendered in India. में यहाँ पे करी है या नहीं, क्या outside से provide कर रहे हो services, outside ही आपने कुछ दिया, then it would be chargeable to tax in India. In this respect, SCP again is a very, very important provision कि आपने services यहाँ नहीं दी, आपने significant economic presence is arising. So वहाँ पे everything is becoming taxable provided that within the prescribed limits or prescribed users में होना चाहिए. वो concepts I think it's not possible for us to cover, but it is really very important for you to understand the concept of SCP also along with the equalization levy also. Equalization levy में आपको देखोगे there is one provision which is saying the royalty which is chargeable to tax as per the provisions of this will not come into the ambit of equalization levy. So बहुत interlinking है वहाँ पे इन तीनों provisions में. आप देखो SCP, equalization levy और ये royalty भी, of course if it is in the nature of royalty, then you have to see taxability. It is becoming very vast actually. SCP is covering major things into its ambit now. So this is the rates. Section 115A की rates are given if it is in pursuance an agreement made by a non-resident or a foreign company with the government, then 10% of such royalty will be applicable. However, DT apply करता है, provides for a lower rate, then lower rate will be applicable, whichever is beneficial, right? So one more thing, one is the important information you have to check into in your case studies, कि if the royalty is that whatever be the right or property or the services you are rendering is effectively connected to a PE. If a foreign company or a foreign entity has a PE in India, then you have to check and see whether those services are effectively connected with the PE. Then in that case, you are not going to apply section 115A. Section 44DA come into picture in that case, right? So this is the thing you have to look for the information. If P is given, if it is being effectively connected or not. If it is not, something is given, then you have to take some assumption also. In that case, whatever assumption you are taking, you have to clearly mention, because if this is the paper now where certain assumptions are also possible. So whatever assumption you are taking in absence of relevant information, then you should mention that information in your assumption in your answer sheet very, very clearly, that on this basis I am solving my answer accordingly. Okay?
In case of an MCQ, sometimes it is possible that they miss out agreement. That is approved by an agreement, but that fourth option rate might not be there. Without agreement, only the with agreement wala rate might be there. Then you don't have a choice but to make an assumption. Otherwise, in the absence of a express statement that the agreement is approved by the central government, you should not yourself assume that it is approved and then give the rates. But sometimes it's possible that you can write it as a part of your answer, assuming that it is approved. But when you are particularly assuming a concessional rate, you have to write the assumption if it's not given. And in case of an MCQ, you have to be careful if nothing is mentioned and you have a general rate of 40%, which is not in agreement cases, then you will have to take that into consideration. Sometimes it may happen that they don't give the full information, because of which two views are possible in MCQs also. Then accordingly you have to do it. If nothing is mentioned, you have to take that the agreement is not approved by the government in an MCQ. Unless that option itself is not there. Then you don't have a choice but to take that it is approved by the central government. Because it has happened earlier that in a particular case, they had not given that the agreement is approved by the central government, that the option contained only the rate based on approval by the central government. Then in such a case, you don't have an option. But otherwise, I'm telling you, options are available. And if it's mentioned, if it's not mentioned that there is an agreement with the central government, you should not assume on your own that the agreement is with the central government. That is one thing which is very important. And actually, we are running short of time. So I just thought I will tell you something. As far as advanced ruling is concerned, this time it will be only BAR. I told you supplementary is very important. So with the original study material, it had both, because last year covered part of AAR and part of BAR. Both were given in the study material, but your supplementary contains only BAR. Only BAR, Board for Advanced Ruling, is relevant for the purpose of May 23 examination. Board for Advanced Ruling, the ruling given is not binding. You can further appeal to the High Court. Accordingly, even the case studies, which in the case study digest now, you have to keep this in mind. Your answer will change as far as bar is concerned, and as far as 115 BBD, as we said, that is no longer applicable, that concessional rate. So dividend from specified foreign company will also be chargeable to tax at normal rates. These are the two important amendments which have an impact on many of the case studies in the case study digest. But of course, there might be other amendments in direct taxes which will also impact,
like enhanced surcharge on long-term capital gain tax 112, not applicable, enhanced surcharge. So some of the amendments, of course, you have to go and see the paper 7 supplementary also for this, for preparing for this Paper-6C.
Okay, but otherwise, majority of the provisions remain the same. With as far as international taxation is concerned, with the exception of advanced ruling and 115 BBD, DT amendments, of course, you have to take into consideration DT amendments also. Anyway, you will be studying direct taxes as part of your core paper, so that you will have to apply it when you're doing the paper on international taxation also. And all the very best to all of you, and keep in mind the time management techniques. Solve all the questions which are given in the study material also. Read it along with the supplementary. In case there are some changes by virtue of the amendment in the supplementary, then you will have to incorporate it. You will get an idea of how to interplay between royalty, FTS. If it falls within the definition of royalty, you tax it under the Income Tax Act. If it goes outside the purview of definition of royalty, whether equalization levy is attracted in such a case. So all these things you will have to examine. Those questions are there as part of the study material also. The case studies also it's discussed. So work it all out and plan your studies accordingly. All the best to all of you.
All the very best to all of you.